Good morning, Cheetah. Good morning, everybody. Good morning and welcome. How's everyone doing today? Hopefully you guys are doing great. Ready to do some stuff. Had an awesome little visit from John Novak this morning, throwing some lessons in there. You gotta love that. When the CEO, the guy that wrote the software, comes in and says, hey guys, check out this pattern I can teach you. I love that. Let's do it. What do you say? I slept so good last night. You guys are in trouble. So we're going to do kind of what we did yesterday, guys. We're going to talk about patterns. Everybody hear me okay? We're good? And then Gerard, hopefully I fixed the YouTube problem. I went through and cranked up every mic that it gave me the option to crank up. So hopefully it works. Guys, we're going to talk about patterns today, a lot about patterns. We're going to talk about rules, we're going to talk about advantages, and we're probably going to touch on the topic of patience a lot. Everything that you do as a trader should revolve around advantages. Everything that you do to get into the market, everything that you do to exit a position. Paul, I'm sorry to keep you out of the dive bars. Those are a lot of fun. But guys, everything is patterns. And everything is patterns that repeat themselves. And even more so, everything is patterns that have been proven over the course of time through study, through pictures, through practice, through back testing. Patterns that have been proven to win more than they lose, guys. And that's the statistical advantage that the patterns give you. The software allows you to recognize these patterns with ease. This is what I teach in the first hour every hour, is the most basic pattern recognition. So everything is advantages. Good morning, John C. And one of the biggest advantages that I feel like I can give myself each and every day is checking forexfactory.com and making sure that I'm not trading into a news release. I have zero opinion about news releases. I have nothing in my plan that says to trade the news, to gauge what I'm going to do based on what they say. But there's a lot of people with a lot of money that do. And I choose not to trade in the markets when I see one of these red boxes. And we have this at 10 a.m. today, guys, the JOLTS job openings. Doesn't matter to me what Jolt's job opening is. I think about that old high sugar soda from the 80s. But if you're curious, you can come through and take a look, right? This is the number of job openings during the reported month, excluding the farming industry. It tells you what the effect is, what it means, blah, blah, blah. All you really need to know is that there's somebody just waiting for that one. It's like that movie Trading Places. They're waiting for the orange juice reports. And then they'll make their buying or selling decisions based off that, guys. And it can make the market move very erratic. It can make it jump and bump and spike. We had someone yesterday took trade right into 10 a.m. news and got stopped out quickly because the market fluctuated so fast in such a short time period. There was no time to react. It was just kind of instant annihilation. So, guys, I check this every morning. And then everything that I talk about is coming from the nexgent3.com site. And it's kind of funny because John Novak and I were talking a while back. And one of the things that Nexgen used to do was offer seminars. We would have seminars, we'd bring you guys into a room, and we would talk about patterns, and we'd talk about advantages, and we'd talk about all the different things that we do, and it was fun. It was a big camaraderie thing. And John and I were talking. I was like, man, we should do seminars again. Those are a lot of fun. And he told me, he goes, Mark, you give them everything in the room. What would you teach them? You give every user everything that they need to be successful in the room. He goes, you would just be standing in front of them saying the same thing. And I was like, you're right. And he's absolutely right, guys. Everything that you need to be successful with this software, you're going to get in this room. I'm going to give you everything. And that's true. We could hang out and get drunk. And you know what? That's happened more than once. Part parties at my brother's house in Houston were things of legend, especially on seminar weekends. Um, but the thing is I guess the point that I'm making, inebriation aside, is that I really do, guys. I work as hard as I can to give you anything and everything that you need to be successful with the software. I don't want to hold back. I want to give you a plan. I want to give you rules. I want to give you recognition. And I want to teach you how to study it. And that's my goal every day. So everything's going to come from this page. And then if you go down in the education tab to the trading guide, the trading guide is where everything that I talk about comes from. All of the rules. There's a glossary of common terms that talks about what you're looking at on your charts, the things that you're going to hear in the room. And the most important one in this entire glossary of common terms, in my opinion, is what we call a high probability trade. This high probability trade, the way it's taught in this room, is a high probability trend trade. And each indicator on every chart is going to agree with the rules for the trade, guys. That's what makes it high probability. It's high probability because it's been back tested, it's been put through the ringer, it's been traded live, it has been studied, it has been verified, it has been validated, and this is a trade that typically wins 70 to 80% of the time when you follow the rules. And that success rate creates confidence because every time you win a trade, you feel a little better about what you're doing. So one of my goals for you guys is to put you in the position to win more than you lose as a brand new user, so you develop that confidence, so you continue to focus on the study. This high probability trend trade, your triggers are going to be the strongest, and there'll be no termination conditions, and there'll be no trouble spots between your entry and your exit. And while this is an awesome trade to give you the opportunity to actually get paid while you're learning, this high probability trend trade does something that's so much more important than that, and it turns you into a chart reader. And in the beginning, I was like, I don't want to be a chart reader. I just want to learn these trades. But you guys that have been with me for a while are beginning to see the advantages. When you can look at your indicators, when you get good at chart reading, you will understand where the market is likely to continue. You'll be able to enter the market at these points. You'll also understand where the market is likely to go. And these become awesome targets. And then where it's likely to stop is probably one of the most valuable lessons that I teach outside of momentum, because these likely to stop areas can not only stop the market cold in its tracks and just end that forward progress, but these likely to stop areas, these termination conditions as we call them, when they reverse the market, when price reverses off of a key area and heads the other direction, it sets you up for the highest chance of success on almost any trade that you can take, but initially that highest probability trend trade. So it's okay as a brand new user. So during the initial 30 days of your trading journey, focus your attention on entries for the highest probability trend trade that you can take. Focus your attention on taking the very basic rules and finding an entry. And guys, we're going to keep it simple. We're only going to have 3 rules. 3 rules are designed to get you into the market. And you need to let yourself be okay with the idea that either your rules are met or they're not. You either have these advantages or you don't. Each rule provides a very specific advantage. The first rule, strong trigger lines on the large chart, gives you the advantage of momentum. The second rule, no termination conditions, gives you a clear path. And then the final rule is going to get you in at the point where the market is most likely to continue, guys. So these 3 rules are your high probability trend trade. And you're going to be tempted to add scenarios, add rules, add conditions. Keep it simple initially. And these 3 rules, I changed my picture for you guys, happen on only 2 charts. So there's a large chart and a small chart. I wanted to show that refinement process. 1 bar on the large chart, the most current bar on the large chart, I circled it historically here. It's going to define the direction of the market. It will define whether or not you have the advantage of momentum through rule number 1. And it will define whether or not you have a clear path via rule number 2. Guys, rules 1 and 2 are met on the large chart. You have 66% of your advantages in place before you ever turn your attention to the smaller, faster chart. But on the smaller, faster chart, rule number 3 is going to show where the market is likely to continue, guys. And it's going to do that with like this X-ray of price. This one bar, the bottom of this one bar, is the beginning of this entire pullback on a smaller, faster chart. All of this is still inside of this bar, but we're going to use this X-ray, and you're going to pinpoint exactly where the market is most likely to continue. It's going to allow you to reduce your risk, and it's going to allow you to maximize your profit potential. So we're going to keep it simple. And guys, the easiest way to get to where you want to be, can't stress this enough, post in the room. It says post your trades in class. Guys, post pictures if you have a question about something that you see on your charts. Write out a question if you're curious about any of these rules as I go through it. The more pictures you take, the more charts you annotate, the more, hey, what's up, Steve? I feel inclined to say good day now, and I don't know. Is that cultural appropriation? I don't know what the termination is anymore. Post your trades in class, guys. Everything you do, win, lose, or draw, post them in class, because what happens is every time you post, you and I are going to have a private session. You and I are going to talk about what you did, what you saw, how you felt, where you got in, where you got out. And that's where this picture comes in, guys. And this is such an important thing. When you post in the room, don't just throw a picture in there and say, okay, Mark, make me smarter, right? Because the goal is to make you a chart reader. So I need to know what your read was. Did you have momentum? Was there a clear path? What did you use for an entry area? And what we'll do is you'll tell me exactly what you saw. You'll tell me the whys, why I did this. Mark, this is why I got into this short trade, and this is where I got out of this short trade. Let's talk about it. And that's exactly what we'll do is we'll talk about it. We'll talk about advantages, momentum, clear path. We'll talk about entry areas, and we'll really work kind of side by side. Hey, what's up, PFI? Good to see you in here. We'll work side by side, hand in hand every day to make sure that your chart reads are where they need to be, to make sure that you're reading your indicators properly. Post it in the room. You know the rules. But the answer is once. I needed the money. If your entry is maybe a little early, we'll talk about it. If it's a little late, we'll talk about it. But guys, every time you post in the room, you get a private session with me. Good morning, Miss Adriana. And every time you post in the room, you're going to get feedback. We're going to talk about what you did well, what could use a little work, what's costing you money, what's making you money. And what you're going to do is you're going to take these charts, these annotated charts, you're going to take this feedback and you're going to drop it into the spreadsheet that Nexgen gave you when you first downloaded software. And guys, it's in the Nexgen Study Picks folder. There's a blank version for you. But I'm going to give you my copy right now. I like to share my copy every day. I like to make sure that you guys have it because the spreadsheet, along with pictures, is one of the most valuable tools to getting to where you want to be. So there's 4 tabs. There's the copy of my tracking. This is where you're going to post every trade that you take on Simulator. You're going to talk about how you felt, what you saw, where you entered, where you exited. But most importantly, guys, is you're going to take the feedback from posting in class and drop it into this notes section. Re-annotate your charts. Because when I was learning the software, one of the things that I did is I believed that I was following rules 100%. And until I posted in John Novak's room, until I started asking for help to get that little bit of coaching, I had no idea that I was breaking rules. And then when the feedback came in, I was able to look at it, to come back to study those notes, and then focus on rule adherence, to try and eliminate the things that were costing me money. As we learn the high probability trend trade, there's only 3 rules. I created this 101 section in the spreadsheet, guys, that has the rules outlined in green. I want you to go back and take a lot of pictures of the individual pieces of the trade. Learn the momentum, learn the clear path, learn the entries, and then you'll pop those together to create a trade. There's a section called favorite looks. This is where when you take a trade and you and I virtual high five, we're like, Jen, that was the best trend trade ever. It had every advantage. Your entry was perfect. Your exit was outstanding. You're going to drop that picture in here, and what you're going to do is you're going to come back and study it. And you're going to say, this is the look. This is what it's going to take to get me in the market because this is the best of the best and my investment's worth it. And then finally, there's the client trades, guys. And this is where I've put in a couple hours for you. There's over 350 pictures of you guys using the software and using it well. If you're brand new, I would encourage you to start clicking on these pictures to recognize the advantages, to read the annotations, and to begin to see that all it is a pattern. There is the high probability trend trade short, long entry sequences. Our entries are very mechanical. They're very if-then. They're very just emotionless. Let the rules be met. There's a management plan to help you guys overcome the fear of losing that's there for you. There's patterns that repeat themselves, termination conditions, a lot about how to manage trades to be able to hold for bigger moves. And then for you guys that love the nightlife and love to boogie, there's NASDAQ. Guys, NASDAQ is a different animal. NASDAQ is temperamental, has a different set of rules for entry in some cases. And NASDAQ is not for the faint of heart of the person that's not comfortable with their chart reading. You should be able to make decisions on whether or not your rules are met inside of 2 to 3 seconds if you're going to trade the NASDAQ. If you can't, you're going to find yourself run over a lot. But that spreadsheet was dropped in the room. It's there for you. So guys, post a lot of pictures. Tell me why you did what you did. Put that feedback into the spreadsheet, but go back and study it every morning. Ask yourself what worked. Ask yourself what didn't work. Focus on the things that felt easy, that kept you relaxed. And you're going to see this cool correlation between following rules and dry palms instead of sweaty palms, and no nervous butterflies in your stomach. Because what we're doing in the beginning, guys, is we're practicing and we're building this trust in a methodology, and we're proving to ourselves. Come into it with a little bit of doubt. I'm okay with that. You're proving to yourself that when you trade this high probability trend trade, when you follow these rules, when you take that entry, that it is in fact a trade that wins more than it loses. And you're going to focus on that because the whole goal is to have an advantage. So we're going to take the first hour and we're going to learn the trigger line rules and the Fibonacci rules for when it's okay to trade. You guys are going to post in here just like PFI did. When there is a pullback to the mid band but synthetic triggers are above, is this a bad setup in your experience? PFI, great question. And we'll talk about it in entries if that's okay. But I'm going to give you this right here. I made this over the weekend for someone else that had that question. If you'll give that a glance and then show back up in about 15 minutes, we'll go over entries and we'll get even more into it. But what I think I did, PFI, because I had this question a lot, you know how rule number 3 says areas inside of triggers? You're comfortable with that rule, right, PFI? You've been doing this a while. Well, even just this right here, a large chart would help if we were deciding if rules were met. So PFI, these are your large triggers from the large chart. These are the large triggers from your small chart, right? The woo is jacked. Only one of them has a line inside of it. Only one of them has an area, someplace for a bounce, right? Doesn't that pretty much omit this top area? If you're looking for any sort of trend trade from an area inside of triggers, it's almost too easy. And if you want to take that trade, not what you meant. When there is a pullback to a mid band but synthetic triggers are above, is this a bad setup? So, and guys, this is pretty cool. All right, is the area inside of triggers? If price pulls back to the mid band inside of a trigger, does it fit your rules? Hold on, let me show you why I'm doing this. Yes, but no. Because of the woo. So what is so PFI, let's come back. Will you come back for entries so I don't confuse everybody in this room? I know what the woo is. Read that little Word document and let me know if that helps. And then we'll get on entries. And guys, we will absolutely annihilate this until we are 100% clear. And that's how the classroom works. And that's why I clicked on PFIs, because I want to show you guys all you have to do is ask a question. And I may say, hey, let's wait for entries because that's where it makes the most sense. But we will answer the question and we will talk about it. In PFI, when you read that Word document, I think what you're going to find is that it makes a lot of sense regarding those entries for the trend trade. So I'll see you in about 15 and we'll do that, guys. So we're going to learn the trigger line and the Fibonacci rules for when it's okay to trade, which means that we're going to cover those entries in depth, guys. We're going to talk about momentum. We're going to talk about the areas. You're welcome, PFI, and thank you, man, because you just made this class better. You guys can simulate, you can practice, you can post in the room, guys, but the goal is that you're practicing the right rules. And if you're not sure if you have the right rules, well, then you have to ask the same way PFI just did, right? Hey, Mark, I need a little clarity on this. Let's fix it. And hell yeah, we're going to fix it. I want you guys to simplify. One of the things that I see new users do more than anything else is try to catch all the trades. Somebody posted in the room yesterday that when they were trying to catch every move too soon, they weren't ready to catch it. They weren't catching much of anything except the losers. But once they took a deep breath, calmed down, and went back to simplicity, they found that their success rate went up dramatically. So that's what we're going to do, guys. I'm going to give you a plan that optimizes your chances of success with the high probability trend trade. I'm also going to give you a plan that optimizes your chances of success with another style trade, what we call a medium trade. And I'm only going to give you two. And until you master the first, don't go to the second. But by the time you master the second, guys, 30 days probably, you're going to see a bajillion opportunities out there. So we want you focused on the rules. We want to keep it simple, but you have to learn the looks. And that's the biggest thing, guys. If you don't know what it looks like when the market isn't moving, for example, this is a high probability trend trade. Study it, talk about it, annotate it. Make sure that you know what it looks like when absolutely nothing is moving. And then what that does for you guys is when you go to a live market, you don't have any hesitation. You can start talking about the advantages and whether or not there's a trade to be had because the market's moving. And the easier the looks become through recognition, through filling out the spreadsheet, the quicker the recognition is when you're in a live market. So I'm going to go to the old, we're going to go to the old slideshow and let's talk rules. Let's talk rules. Where is the one I'm looking for? There we go. There's 3 rules. And each rule creates an advantage, guys. So we're not talking about, is it a long trade? Is it a short trade? What we're going to do is we're going to say, do I have the rules met? Do I have the advantages? Large chart must have strong trigger lines. And if you guys remember, the large chart is going to define direction, momentum, and areas. The first 2 rules are coming from the large chart. The first of those 2 rules says strong trigger lines on the large chart. It's going to give you the advantage of momentum. So it's going to define direction, guys. Large chart's going to tell you if the market's going up or down. If the background is green on the large chart, it's going up. If the background is red, it's going down. It's pretty easy. When the market is going up, when I have an uptrend, guys, the only way that I can have strong triggers, the absolutely, positively, without question, only way that I can have the advantage of momentum is if my trigger lines are the exact same color as one another and the background. So in an uptrend, small triggers, these solid lines, and the large triggers, those dashed lines, they both have to be green. The small triggers have to be up and above the large triggers. Large triggers have to be widening. You don't want flat triggers. Flat triggers have no momentum. So they're widening. With the small triggers above, with the space created between the two, the odds are favorable for the market to continue up. When I have odds favorable momentum to the upside, you're going to hear odds favorable momentum all day long. When I have odds favorable momentum to the upside, I'm going to be able to use that refinement chart, that smaller, faster chart, and pinpoint exactly where these tails are likely to form. Remember, 1 bar on the large chart is a complete refinement process on the small chart. You guys will be able to pinpoint where these tails are likely to form. This becomes your entry for the highest probability trend trade. In a downtrend, when the background is red, smalls below the large, larger wide, space between the two, guys, this is telling me that the odds are favorable for the market to continue down. Once again, odds favorable momentum. That's your advantage of momentum, guys. You'll be able to sell Fibonacci resistance on a smaller, faster chart. You'll be able to pinpoint exactly where the market is most likely to continue. And after the fact, it's going to look like one of these tails. We're not going to trade these tails. We're going to use that refinement process to pinpoint exactly where that tail is most likely to form. So odds favorable momentum, guys, this is going to be your battle cry because odds favorable momentum pushes a market. Odds favorable momentum breaks key Fibonacci areas at times. Odds favorable momentum will even cover a lot of mistakes that we make as new users. Odds favorable momentum, you're going to see in this classroom, is the basis for an awful lot of trading plans that go beyond that high probability trend trade. And then odds favorable momentum doesn't last all day, guys. There's a very distinct life cycle. As the small triggers accelerate, momentum is growing, it kind of peaks, and as they begin to come back to the large triggers, visually you can say to yourself, hey, I'm losing momentum. And when the small triggers work their way back inside of the large triggers, guys, this is what we call a weakening of the large triggers. Your advantage of momentum is no longer present. Any trade that you take can no longer be a high probability trend trade because that first advantage is gone. When you have weakened triggers, guys, anything can happen up or down. Such a great lesson because anything can happen. Let the words resonate in your head. Anything can happen. Hey, I want to bet $1,000. But anything could happen. Or I want to put my $1,000 in the market and the odds are favorable. Which one are you going to spend your money on, guys? Hopefully odds favorable. Because when it's odds favorable, the best of the best, you're going to be able to sell Fibonacci resistance. These are where your advantages lie. As the small triggers return, momentum is waning. You're going to be able to use your chart reading as you grow with the software to still find opportunities, whether it's a slowing trend or whether it's as anything can happen. But your chart reading is going to give you the ability to manage aggressively, to recognize change on a smaller, faster chart, to still be able to capture profits and protect your investment because you know you have to be more aggressive. And these weak triggers, when they hit areas, guys, that takes us right into rule number 2. Weak triggers at Fibonacci key areas, guys, that can stop the market. And they're more likely to stop without the strength of that push. So I'm going to ask real quick, is everybody good? Let's go to my large chart here. Actually, we could do either, but I'm going to take a large chart. This is the most current bar, guys. Smalls are above the large are wide, the smalls are above, the space is there. Can you give me a Y in the room if you can see that I do, in fact, have odds favorable momentum in the moment on crude oil? Guys, this is a huge look, a huge advantage, because if you go back, check it out. Strong triggers to the downside. And it pushed hard right to one of those lines. Weak triggers. Look at the reversal right from an area. Even with strength, these key areas can ruin your good time. And we're about to talk about that. Right into resistance. And it bounces, but it was odds favorable to get there. And then, guys, there's one of those tails, right? With those strong triggers. Look what happens if I circle the tail. If I go to a smaller, faster chart and find that circle, I want you to see how this refinement process works when you have odds favorable momentum. Where's my smaller chart? There it is. There's that refinement process, guys. The large chart says down. The large chart has strength. I don't trade this tail. Look at where that tail winds up on a smaller, faster chart. I'm going to teach you how to pinpoint this, but you'll be able to go back historically, circle these tails, and test the methodology. And that's really kind of a cool thing, being able to do that. So odds favorable momentum, guys, let it set the tone. Let it be the reason that you're looking for a trade. Odds favorable momentum can break areas, can cover mistakes. Odds favorable momentum, yeah, you know, just to say it, it's pretty kick-ass. I'm a huge fan. But once I have it, I got to make sure that I'm not trading into those likely to stop areas. I have to make sure that I'm not trading into an area that has the potential or the capability to ruin my good time. And termination conditions on the large chart, when there are none, you'll have a clear path. There's your second advantage. We use lines on the large chart. Because lines are where the people that control the market are making decisions. Lines are where buyers are buying and sellers are selling. Lines are where the people that make things go up and down in the market are reacting. They're making decisions. They're entering, they're exiting. You guys know about these lines long before we get to them. The ones that we're looking for: divergence high, divergence low. We're looking for red Fibonacci resistance, blue Fibonacci support, yellow 1-to-1s. And all of these lines have the potential to cause trouble. We're going to use the trigger lines, guys, the same way we use trigger lines to determine momentum. We're going to use them to determine whether or not the areas are likely to stop the market. It's a termination condition. Whether these areas have the potential to break, or whether these areas are broken and we do in fact have that clear path until we reach the next key area. And we're going to do that with a pretty basic recipe, guys. Price has to reach the area. If decisions are being made at areas, price has to get there to set off that decision-making process. When price reaches Fibonacci support in this picture, the only thing that you guys have to do, the only job that you have, is to ask yourself where the triggers are. If price reaches Fibonacci support and the trigger lines remain above, no more short trades into the area, guys. That's a termination condition. It may stop the market. It may create an untradeable bounce. Hell, there might just be a fight there for the next hour. But price reaches triggers above, no trade. If price reaches Fibonacci resistance and the trigger lines remain below, absolutely no trades. And guys, this recipe never changes. As you grow with the software, as you begin to learn more and more about patterns, there's going to be times where you might be willing to take a risk. But in the very beginning, if price reaches an area of resistance, if price trades up to a line and the triggers remain below, no long trades into that area. It may stop the market. Resistance, 1-to-1s, divergence highs. Let me give you guys this picture. This is pretty good study material here. I don't know what that means. Can I give you a quick answer, ES, now? I don't even have the S&P open, PFI. You'd have to show me a picture and ask me a question. But I'm not going to give you a read to take a trade, guys. I don't call trades. At a low, price reaches the area, triggers remain above. No short trades, guys. It really is that simple. It really can be that easy. If price reaches the area and the trigger lines remain above, then I'm not going short into that area. And guys, this recipe is never going to change. It's never going to change. What do your rules say? PFI, what is your rule for entry? Did you read the pamphlet I gave you? Well then, how the hell are you going to trade? So I'll tell you what, instead of trying to get paid, and I apologize if I sound like I'm being shitty here, instead of trying to find trades, why don't you look for advantages? Give me 5 days, PFI. Learn momentum, learn termination conditions, and then learn entries. And I promise you, I shit you not, PFI, if you allow it to be simple, if you allow it to be that basic, if you allow it to be nothing but advantages getting you into the market, then the only thing that you're going to be able to say is, I don't have an area inside of favorable large triggers. This is not a high probability trend trade. In order to take this trade, I probably need some level of confirmation. Your trend lines mean nothing to the high probability trend trade, right? There may be a way to incorporate them, but this is only one chart. This is a 5-1 chart. What is the large chart telling us? I don't care about the small chart if my rules aren't met on the large chart. And I'm telling you, well, you're paying attention to them, right? No, you're just drawing them on there to distract you? It's okay. Give me a 2-part picture and we'll go through when I'm done with the rules to see if the rules were met. Let me know how that market turns out. Let me know if it goes below. And maybe read that little thing that I gave you. It might be helpful. So guys, there's 3 options. It tanked, didn't it? Because your areas weren't inside of favorable large triggers. Rule number 3 kept you out of that trade. If you traded that with an opinion, Your opinion just got shoved up in you. Can you guys give me a why in the room if you're with me? Price reaches an area, triggers remain below resistance, above support, just no trades. You've lost your advantage of a clear path, guys, and I'm telling you right now, this is the most broken rule by new users. This is the one that ate my lunch for about a month until I finally got help with it. If the small triggers and the large triggers get beyond the area in question, this area is considered broken and your path is clear until you reach the next path, or the next line, guys. So once the small and the large get above resistance, resistance behaves as support. Look at that. There's odds favorable momentum and a clear path, and there's one of those tails that you guys can pinpoint. Guys, this is the easiest way as a brand new user to be able to understand whether or not you've reached an area that may stop the market. And let me show you how easy it can be. Let's pull up that large chart. Yeah, don't believe me, Rob. Let me read that. Mark, we've all heard people talk and say, believe me. The thing is with Nexgen and study, it's amazing to verify you know what you're talking about. Thank you for that. Guys, don't trust me. I'm 3 sheets to the wind, drunk, maybe a little high, and I hit my head yesterday, right? So go back and take these rules that I give you and prove that they work. And that's what Rob just said. Not really, PFI. But I want you guys to see this. And this is one picture, right? This is crude oil, one picture. I want you guys to see something pretty outstanding. This is how you develop trust in rules, guys. Weak triggers, and there was a deeper pullback, right? It hit resistance and all the triggers remain below. Rule number 2 says don't go long. Rule number 1 says don't go short. You don't get caught up in the mess. The area breaks, small and large get below support, it becomes resistance. You have odds favorable momentum. Ladies and gentlemen, each and every one of you in this room is going to be 100% capable of pinpointing where this tail is most likely to form and taking this trade all the way down to the next area of support where not one trigger broke through it and you chose not to go short and lose any money before that big honkin' bounce. Price reach resistance, triggers remain below. Rule number 2 keeps you out of the long. Odds favorable momentum, but the area is not broken. I'm going to give you a set of rules to understand whether or not that's appropriate. Right back into terms, guys, right back into a divergence low. Your rules are 100% designed to optimize your chances of success. And guys, if you don't believe in termination conditions, there it is again. There it is again. Let's see what happened. There's a termination condition that started the whole move down, guys. And what you do is you go back and you start studying these and you look at these and you're like, holy crap. There may be something to price reaching Fibonacci resistance and the triggers remaining below that alleviates me of my advantage. Do you guys see it? Do you see how this was a termination condition? How it said don't take the trade? Pretty cool, right? Rob, I love momentum. I'm not mad at you for that. So guys, keep it simple in the beginning. If price reaches, triggers don't break, sit on your hands. If both triggers clear that area, let's look for an opportunity. Let's look for that trade. Let's look for that clear path for that momentum and figure out how to capitalize on it. Once you're good at these two, guys, and it won't take you long if you're taking pictures, I'm going to introduce you to the next scenario, and this will be your medium probability trade. This is the second trade. Once you're a chart reader, guys, this trade's pretty easy. If you try to start taking this trade without the ability to read your indicators, it's going to eat your lunch. That's my phrase for the day. When your small triggers absolutely smash through the area with odds favorable momentum, right here, we have to sit on our hands. Right here, go cat go. But that little transition phase, when the small triggers break through but the large triggers lag behind, 50% of my triggers are through, 50% are not. That's what we call this trade, guys, a 50-50 trade. You could call it a trigger straddling the line trade. I don't care what you call it, but what it means with this, look, when I have odds favorable momentum, When the small triggers make it through the area, this is an area with the potential to break. This is not an area that's broken, guys. This is an area with the potential to break, which means that no matter how much I want this to be high probability, it isn't, because I don't have a clear path. And if I don't have a clear path, then I'm going to really be kind of insistent on a few different things. I'm going to be insistent that the momentum is out freaking standing. And I'm going to be very insistent that if I take an entry, it's the lowest possible risk, because it's not a high probability trade, because the area hasn't broken. And sometimes you'll think that it's about to break and they will reverse completely on you. So I'm going to give you a plan to take this one. This is your second trade. But I want to go back to this picture, because this picture reminds us. Did I say it yet? 90% of your day will be spent reading indicators. 90% of your day will be waiting for advantages. Ladies and gentlemen, those of you that are brand new with me, write it down on a piece of paper, call your wife and say, hey honey, 90% of my day I'm not going to be doing anything. I'm going to be waiting for advantages. Call your husband and say, hey babe, I have to sit on my hands for 90% of the day. I might need you to buy me a book or something so that I can read and distract myself. Because 90% of the day, guys, the advantages aren't there. 90% of the day, there's a termination condition, even when odds favorable momentum brings you to it. 90% of the day, that bounce, another termination. Trigger line colors don't match. All my triggers are below. Nothing matches still. Into a mid band with the large triggers a full bar away. I can't do anything. The area is not broken. Son of a gun, there's nothing going on until magically I end up with momentum and a clear path. Amazingly, I'm able to pinpoint where that tail is most likely to form. Guys, this 90% right here, and I'm going to tell you right now because I've fallen victim to it. This 90% is where, this is what we call unnecessary, that's a hard word. Unnecessary losses, guys. Unnecessary losses. Trading without advantages are unnecessary losses. Trading without advantages or walking into the bar and picking a fight with the biggest guy because you're feeling tough, right? You just watched the UFC. You saw him armbar somebody and you're like, I'm going to do that to the biggest dude in the bar. And then the biggest guy in the bar just whips the ever-loving shit out of you because it turns out you didn't have an advantage, right? So wait for those advantages, guys. This is your 10%. This is where it's easy. This is where life is not stressful. And someone said in this room, and I think he's in here today, that when you stop trying to force trades when your rules aren't met, they just seem to come to you. And there's no more true statement than that, guys. So price reaches an area, triggers don't break, sit on your hands. Be okay with the idea. Be okay with the idea that you're not in control. And then unnecessary losses. When price reaches a mid band and the large triggers remain a full bar away, the area, it's likely to pull back. That's your gap theory, right, Jen? That's a pattern that states that the mid band is behaving as a termination condition. Don't take a short trade. Jen took a picture of it and said, you know what? I need to remind myself of this. And she took that picture, and I guarantee she did this because, you know, Jen's pretty smart. What did I do? Jen said, you know what? This is the look that costs me money if I don't stay in tune with it. So let me go to patterns that repeat themselves. Or let me go to termination conditions. And let me grab that picture and let me put it in here. And I'll go back and study it tomorrow. And I'm going to call it the gap theory, right? And guys, that's the one time where the midband behaves as a termination condition. That's the only time where the midband behaves as a termination condition. And if you go to tops and bottoms, it tells you right there. The large chart midband if the large triggers are a full bar away. And guys, I'm working on this series of 1 to 2 page, super small worded, not real difficult. And I did midband as a termination condition yesterday. So Jen, there's a little literature for you that goes with your picture. But guys, that's a termination condition. It just says no more short trades. Jen knew that. Jen didn't take a short trade. Jen didn't lose any money. Didn't give away any money, hoping that the market does something that it doesn't typically do. So, lines on the large chart. Guys, lines on the large chart create problems. Lines on the large chart are where decisions are made. Lines on the large chart can stop the market, can create untradeable bounces. Lines on the large chart are what we're looking for when we look for termination conditions initially. Sometimes price doesn't reach a line. Sometimes it turns from the middle of nowhere, even with odds favorable momentum. Does everyone remember the refinement picture that I posted in the room? When that large chart only has one bar cranking down, there's all this information on a smaller, faster chart. Guys, we're going to use that to see change plus the tail. So great question, Steve. Let's back up one, and I'll show you how you're going to use it. When we talk about that gap theory, we talk about a full bar away. Let me get to a picture for you real quick. Great question. Thank you for that. And let me show you exactly what I mean. So price is going to accelerate. Price is going to zoom away from those large triggers. Remember that these triggers, absolutely, John, please do. And you may have to remind me which picture, but we'll get there. When price accelerates away from the large triggers, guys, these triggers are moving averages. This is the same concept that we're going to use when we talk about entries, but when it accelerates away and it goes into an area, fibs, mid bands, and the large triggers are a full bar away. So Steve, when price is all the way up here at 69, the very top of that bar, I don't see a tail yet. I don't see anything. It's going to look exactly like this, right? These tails only form when price retraces. So when price hits up here, I don't see a tail. But if my large triggers remain below this reversal bar marker, and guys, this reversal bar marker is a wider gold line on your large chart. Let me show it to you. Man, where's my large chart? I open a lot of stuff. This gold line is my reversal bar marker. So price reached an area, but my triggers are below it. They're not a full bar away. This is the distance. This is where this bar becomes an up bar. And the same is true on a smaller, faster chart. And I'll show it to you guys real quick. This reversal bar marker is the exact price that this bar becomes a down bar. So we'll use that for the gap theory. If we reach an area and the large triggers remain above this reversal bar marker, it's likely to close the gap back to those triggers. And what it looks like after the fact is something very much like this. Trading into the mid band, about a full bar back. There's a better example. Full bar back, right? So I hit resistance. I hit a mid band, and there was that whole gap. And look what it does. It pulls right back to those triggers. Even without a full bar, it still tends to pull back to those triggers. Pulls back to those triggers. Guys, these moving averages suck price right back to them. We're taking advantage of that with everything we do to be able to recognize where the market is most likely to continue. So does that make sense, Steve? Awesome. Thank you for asking the question, guys. This is how the class works. And then, John C., this pick, talk to me. What's your question? Thank you. That was easy. And take your time, guys. I know it takes you guys a second to type sometimes. I've got the benefit of a microphone. And then while John C. is typing, guys, sometimes the market doesn't make it to areas, right? These areas are good, but it doesn't always make them. Man, Morgan, it would be a mess. Sometimes you'll even have odds favorable momentum, and that market will be screaming up and the path is clear and it just seems to turn from nowhere. We're going to use divergence on a smaller, faster chart. Hold on. Where there's a circle, but small and large chart don't have gap or need gap between that. So right here, what you're saying is there's not any space between the two? Really? I want to make sure that I understand the question. And let me back up to my picture. Hold on. So let me go back to this one. That's going to make me rewind. So John C., here's the life cycle, right? This is my best. This is my odds favorable. This is unicorns and rainbows. As long as the small triggers are outside of the large, I do have momentum. As long as the small triggers are outside of the large, let the language be very basic. I do have momentum. So even if they're right on top of it, but outside, I still have momentum. When one line goes inside, that momentum starts to weaken. When both lines go inside, it's gone. So when we talk about that picture, and I know it's not that big gap that we love. It's not that best of the best screaming wide look. But the smalls are still outside, and we're still going to call that one momentum. And with that clear path and with that pullback, there's a pretty good chance that we're going to be able to find an entry. But John, honestly, maybe I should change the picture, right? Maybe I should make sure that it is the absolute easiest to read. So thank you for that. I think I'm going to change this picture. It is momentum, but it's not that oh my gosh, children are singing songs about it momentum, right? And it is a clear path. And it is an entry, but I could see how that could be confusing. So let me change. I'm going to put a note down. And guys, I'm telling you, this is what makes the class great. I put a note down, 90% picture. I'm probably going to go through and make it a little more clear. Thank you for that, John C. So guys, lines on the large chart can be problematic. Lines on the small chart are what we're going to use for entries. But we can use this idea of divergence on a smaller, faster chart to help us see changes that we can't see on that large chart because it's so slow. That's awesome, man. All you guys have to do is ask, I promise. But Paul and John, I think really what we did there is you guys were nice enough to point out to me that if I'm going to talk about odds favorable momentum, if I'm going to talk about that big gap between the two, then I should probably show a picture with that, right? I shouldn't make you guys have to think about the idea that it's only close and not gapped. So I'm going to fix it. Thank you. Thank you, thank you. I'm telling you guys, this is how the class gets better. All I need is one good question to make me rethink things. Guys, when price comes down and goes back up, that's a pivot. When price goes up and comes back down, that's a pivot. That's all it is. It's just an up and down. When price goes down and back up, but momentum doesn't follow price, it lags behind, we're losing momentum, your software will run some cool little calculations. And it'll print a negative number in a light blue line from a low, or a negative number in a light blue line from a high. And guys, the negative numbers are a byproduct of the calculation. I want you to think of divergence as either true or not true. It's either there or it isn't. When I get 3 divergences, 3 losses of momentum in the same price range, guys, that may terminate a trend. And what I'm seeing is a slowdown on the small chart that I can't see on the large chart. So 3 divergences in the same price range, it may terminate a trend. It becomes more powerful when the small triggers are inside of the large triggers at that 3rd divergence. Those anything can happen weekend triggers. It becomes more powerful still when that final pivot's higher than the previous or lower than the previous from a high, and it creates what we call a head and shoulders pattern. So 3 divergences may stop the market. 3 with weak triggers makes it more powerful. Throw in that higher pivot. Guys, it's a recipe for doom and gloom if you try to take that next short trade. This is the only time on a smaller, faster chart I'll say that I don't have a clear path. And these 3 divergences in the same price range at a low or a high are going to help you see change that you won't see on that slower moving chart. So guys, that is termination conditions. This is the most broken rule. I don't know why. I'm a victim of it as well. But when I reach an area and the triggers don't break, guys, do you see it? There's 2 perfect examples. And the only thing that you have to do is say to yourself, I don't know. I don't know if it's going to break. Good morning, Erla. I don't know if it's going to hold. I don't know if it's going to bounce. I don't know what the problem's going to be or if there'll even be a problem. But I do know without question that if price reaches an area, even with all this momentum, my best bet as a brand new user is to not take that long trade. If price reaches Fibonacci support right here and the triggers remain above, my best bet is to not take that short trade, to be patient. And when the small triggers break through, well, it has the potential to break. And right now, guys, we're trading potential. We're trading the idea that this area may break because of this momentum. And this area may break because it's coming from a termination condition that reversed the market. And guys, we're about to pinpoint where the market is most likely to continue. And we're going to create a window where that bounce is most likely to happen. 924 stamp. So you said that it was too close, right? John C. I'm trying to line it up. Did it look like that? That's 924, right? Or was it this bar right here? Or are you talking about right about there? Right there, and you said that's too close, right? To hell with that trade. John C., you want to see something amazing? You had 6 ticks from the top of this bar to the fib, right? And John C. is saying, Mark, dude, there is no freaking way I'm taking a trade with only 6 ticks profit potential. Would you agree, John? Does that make sense to everybody? Why on earth would I risk any money for only 6 ticks? Let me show you something amazing. And guys, this is what we're about to learn right now. Let me back this up. John, your rules-based entry was right here at 88, which means that by buying a pullback to an area inside of favorable large triggers, your 6 ticks, nobody wants that trade, just turned into 22 ticks or $220. And John, this was like the greatest segue ever to entries. We don't jump in at the top of the bar. We use that refinement process to pinpoint exactly where the market is most likely to continue. It is a 50-50. Actually, it's a termination condition. But we're talking about the distance to the fib, right? That was your concern? Let's do this, John. Let's cheat. What do you say? And I'm going to draw the fib in because there's a lot of noise. That's where your fib was. Let's take all the noise off of it. No, you're fine. This is great. And we're about to learn how to nail this one. So John, this was a 50-50 trade. You know what? This was a trade that had the potential to break the area, but the area wasn't broken. That's the second trade in the plan. I love that trade. So when I talk about a 50-50 trade, John, the one thing that's important to me is that I don't sacrifice momentum. So I have to have momentum on the large chart, and I also have to have momentum on the small chart. And I have to come from a termination, look at that, divergence low, triggers didn't break, that reverses the market because it creates an advantage. And I have to make sure that my risk is tiny because I want to make sure that I'm not sacrificing momentum and entry when it only has the potential to break. So John, there's a couple things that come into play on this one. No divergence on the small chart, strong triggers on the small chart, tiny little window of opportunity as we're about to teach it on the small chart. I love this trade all day long. It's a little bit advanced beyond the high probability trend trade. It's taking you into the medium probability. So absolutely, it's a 50-50, John. But let's talk about the advantages. Termination that reverses the market, momentum on the large chart, the potential to break on the large chart, no divergence on the small chart, tiny little entry area on the small chart. Ah, John, you will develop the confidence to take this trade. And you're not going to worry about the 6 ticks to resistance because you know that it's 22 ticks from the best entry. Does that make sense? And as we go through entries, it'll make sense even a little bit more. And I need to get all these drawings off of here or I'm going to smash it. And Morgan's absolutely right. Every question that you guys ask is a question that 90% of the class is thinking. So don't ever hesitate to ask questions. But let's talk about rule number 3 now, guys. Let's talk about the idea that when the large chart says go, when the large chart has momentum, when the large chart has that clear path, that we have to look for an entry. We have to find an entry on a smaller, faster chart. We have to use that refinement process to pinpoint where the market is most likely to continue. So what we're going to do is, guys, you're going to be so stinking precise that you're going to use a limit order. And you're going to use that limit order to buy or sell a pullback. And that pullback is that little internal push against everything that the large chart says. You're going to buy or sell a pullback at an area, fibs, midbands, yellow 1-to-1s. On the large chart, these lines created problems. On the small chart, they give us a place to bounce. But we want that area to be inside of triggers, guys. We want it to be inside of what we call favorable large triggers for the brand new user. And we're doing that because favorable large triggers, guys. PFI, are you in here? Favorable large triggers means that the large triggers are overlapping, guys. Rule number 3 has us entering at areas inside of favorable large triggers. Favorable large triggers means that the large triggers, no, don't be sorry. Let's go through and have a great lesson on entries, guys. This is why we use 2 charts. There's 2 sets of large triggers on your small chart. There is a large chart large trigger that is transposed onto the small chart. Why? Because these are moving averages, guys, and price loves to pull back to the average. But we're about advantages. We're about precision. So we're going to take the large triggers on the large chart and the large triggers on the small chart, and we're going to allow them to overlap, one on top of the other. Because what it does is it takes my correction point where I expect the price to return to on the small chart, and it lines it up with the exact same area I expect price to return to on the large chart. I'm creating an advantage with 2 charts, and I'm saying that these trigger lines are where I expect these prices bars to come back to. Does that make sense, everybody? It's just a moving average. It's a regression to the mean, which is way outside of my pay scale. Keep it simple. I expect price to return to triggers on both charts. Are we cool with that? And when the triggers overlap, one on top of the other, 2 snakes riding piggyback, well, then it just gives me one correction spot. But guys, I don't trade pullbacks to triggers. What I do is I trade pullbacks to lines, to areas inside of favorable large triggers. So when my correction point is concise, overlapping one on top of the other, I'm going to look for lines inside of those triggers. This becomes what we call the window of opportunity, guys. And then PFI, going back into your question, if overlapping triggers is the best of the best, if overlapping triggers gives me the least amount of risk, if overlapping triggers gives me the highest chance of the lowest risk entry, well, what's it mean when they begin to split, when those correction points begin to separate? And look at this. If I put a box around the large triggers on the small chart, it's way down here. If I put a box around the synthetic triggers, the large triggers from the large chart, it's way up here. Look at the distance between the correction point, guys. But what do the rules say, PFI? The rules say areas inside of triggers. So what I can do is I can say, I don't have any areas down here. I don't have any areas down here, right? Which means that my rules are never met. I do have an area inside of the synthetics up here, which means that the only way, PFI, the only way my rules could ever be met for an entry is if I focus my attention on the area inside of the triggers, which means that this trigger is 100% off the table. Does that make sense? Because we're about to fix your entries totally. If the rules are met, did it have momentum? Hell yeah, it did. Did it have it? It's hard to tell, but this blue line had the potential to break with all that momentum, didn't it? And then it pulled right back to resistance inside of triggers and it continued to move down. I would say that's a good trade. I would say that's a rules-based trade. Opposite of what? If it were going up, it doesn't matter. So, and thank you for saying that. PFI, where does it say large or synthetic? It doesn't, does it? It says inside of triggers. It says areas inside of triggers. Don't overthink it. My best trade comes from an area inside of triggers. It doesn't specify synthetic trigger. It doesn't specify large trigger. It doesn't say that the large has to be above the synthetic or the synthetic has to be above the large. It doesn't give me any distinction. The only thing my rules say is that my entry has to come from a line inside of the triggers. How easy is that, ladies and gentlemen? The human brain tries to outthink us all the time. The human brain tries to optimize. So absolutely, PFI, the 100% best, without question, no argument, can't sell it any other way. Best look is when they're overlapping one on top of the other, because then you have one concise area where you expect the price bars to return to. Does that make sense? I love this lesson, guys. It took me 3 years to figure it out. It took me 3 years to figure out that price loves to come back to triggers. So if my triggers are one on top of the other, there's less room for price to come back, right? And when there's a line in there, I give it something to bounce off of. I give it something solid to bounce off of. And then check this out. If one correction point is down here and one correction point is up here, neither have lines in them, and my lines are floating in between the two. PFI, do you see how this absolutely sucks? I expect price to return to these triggers or to these triggers, but it has to have something to bounce off of. If my bounce point is floating in the middle of nowhere in between two correction points, it's just ugly. It's not concise. It's not predictable. It's not reduced risk, right? It's not the best of the best. And PFI, the hardest thing that you're ever going to do is look at this scenario and go, you know what? This sucks. It's not my trade. Because my rules say that the areas have to be inside of favorable large triggers. Does that make sense? And then PFI, going off that very simple lesson. Check this out. And let's do this, even without the benefit of the large chart, guys. There's my large trigger. That's one correction point. There's my synthetic triggers, right? So these are the two individuals, but when I'm looking for an entry, I have to go from the lowest line to the top line. Doesn't matter which trigger it is. So the gold box represents where I expect price to return to. Can you guys give me a Y in the room if you see that? The gold box represents the correction point, where I expect price to correct to. The only line that I have, whoops, wrong one. The only line on this chart, guys, is this stupid mid-band floating in the middle of nowhere. In PFI, you said that once it blew past the correction points, it tanked, right? Is that accurate, guys, on the S&P? Once it blew past the correction point, it actually tanked. So if Rule 3 says areas inside of triggers, What does it mean if the area is beyond the correction point? It means that my rules aren't met. It means that that very simple rule designed to optimize my chances of success isn't true. And this is where you have to make the decision. You either say, no, PFI, stop. You either say advantage lost, no trade, right? Or you say, I hope. And I know you were kidding, PFI. And guys, hope is a horrible way to try to make money in the market. Guessing is a horrible way to make money in the market. Hoping, wishing, wanting, praying, hopium. Amen, Pete. But, dun, 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 you guys are giving me the best freaking lessons ever today. Thank you, thank you, thank you. Let's get both of these up. So check it out, guys. On this bar right here, most current bar, did I have odds favorable momentum? Amen, Ron. What do you guys think? Heck yeah. Give me a Y in the room if you see it, guys. There's momentum. Price reached the yellow 1-to-1. It's the first stop, but price reached the yellow 1-to-1 and the triggers didn't break. Can you give me a Y if you see? No, John. In order to be a 50-50, the smalls have to be through the area, the large are not. Do you see that that 1-to-1 dot that produced, that came up? Guys, price reached that yellow 1-to-1 and the triggers hadn't broken it. Absolutely no trade. Does that make sense, John? Okay typically means in this room, shut up, Mark. I don't want you calling on me. I don't really understand the lesson, but I don't want to hold up class. Awesome. Guys, I want you to see what happened here. No, you're okay. Stop saying sorry. It absolutely blew through. Absolutely blew through the entry that we're about to talk about. Paul Flowers, I know you're in Louisiana. You're not that far from me. And guys, this is what we're going to talk about right now. You're in Louisiana? Heck yeah. Picking the best area, guys. Picking the best of the best. But if the large chart says no, the small chart's less likely to work. So let's talk about using a limit order. Are you in Fort Worth, really, Paul? I thought you were in Louisiana for some reason. Oh, shit. We're going to get together for a beer. You're not far from me. I'm just in Fairview. I'm right on the north side of Dallas by McKinney. Guys, rule number 3 says that we're going to use a limit order to buy or sell a pullback inside of favorable large triggers. We're going to use a limit order to buy or sell a pullback at an area inside of favorable large triggers. We're going to insist on favorable large triggers. Lake Charles, I've been there more than once. There is a giant seafood restaurant right on the water there by the casinos that my wife and I went to once. I ate 17 pounds of fried food, yep, and felt sick for 2 days after. It was amazing. So as we revisit entries, guys, favorable large triggers, large and the synthetics, one on top of the other, because this is where price is likely to correct. Are you guys good with that? Everybody happy with that idea? That the tighter these triggers are, the easier your trades are going to be? And once they start to divide, once they start to split, indecision comes into the mix, guys. Is it going to go from the top one or the bottom one? Hell, I don't know. I never know. I never know what the market's going to do, guys. But what I do know is that when I have odds favorable momentum and that my path is clear, I'm not waiting for this tail to form. I'm using this tail to study. I'm looking for areas inside of favorable large triggers on a smaller, faster chart. This is where the market is most likely to continue. This is where my advantage lies. And then going back to, who asked the question about distance? John C. Here, I got $100 or $200 worth of profit potential, right? But from the area inside of favorable large triggers, look at the distance to my target. So guys, our first 20 days, I'm wound up today. You guys are asking the best freaking questions ever. My first 20 days with Nexgen, my first 20 days back with Nexgen, if I took a break, should be focused on finding the point where the market is most likely to continue. So guys, when the large chart says up, when the large chart has momentum, when the large chart tells me without question that I have momentum and a clear path, my job is to be patient enough to wait for a reversal bar on the smaller, faster chart. This signals the beginning of the pullback. This is not your entry for the high probability trend trade. This reversal bar says, hey Mark, guess what? We're going to try and shove the market down. And at the time of the reversal bar, I'm going to go through this very simple process. The first thing I do is I'm going to circle my trigger lines. I'm going to circle the large and the synthetic from the top of the line to the bottom of the line. This is where I expect the market to correct to. Let's do this real quick. This red box, this is where expect price bars to return. This is my correction point, not my entry point. And I think that's an important one. Maybe I need to add this in too. Guys, we're modifying pictures today because your participation is making this class better and it's going to make things easier. This red box is where I expect price to correct to. Is everybody good with that? This is not my entry. When it hits these triggers, that is not my entry. My rules say that I need lines inside of these triggers. I need areas inside of these triggers. I need fibs, I need mid bands, or I need yellow 1-to-1s inside of the triggers. And guys, it's all bold, right? It is bold and caps, and it needs to be inside of favorable large triggers. Because the cool thing is, guys, is I'm throwing a tennis ball as hard as I can. And I know where my wall is. And it's the area inside that I expect to produce a bounce. It's the area inside that I expect to produce a bounce. Is a reversal bar inside of favorable large triggers an area? Absolutely not. How could price ever be an area? That's all a reversal bar is, Jen. It's just a fluctuation of price. Here, look at this. Let me see if I can make it easy. See how as the bar goes up and down, so does the price? That's not an area. What's an area? Let's see what the large chart looks like. Dun, 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 dun. Look at that. Smalls are outside. This has the potential to break. I'm waiting for a reversal bar. If I get a reversal bar, price is likely to correct somewhere inside of these triggers. I have to find the areas inside of those triggers, and that's how I decide where the entries come from. This is a reversal bar, Jen. When you have a bunch of green bars, your reversal bar is the red bar that's going down, that shows a little reversal in price. When everything is going down, a reversal bar is an up bar. The yellow, these yellow 1-to-1s, the yellow thing that pops up, this right here. Okay, so what this is saying, Jen, thank you, is that if this bar that's currently trying to form, if it pushes down to 73, well, now 29, and this will chase it. If this bar is able to push down to 73.29, it's going to be a red reversal bar. It's going to be a down bar. So a reversal bar marker, all it does is it shows you exactly where the most current bar will become a down bar. It does it on the large chart too. The large chart has to come all the way down to 73.13, and that'll be my first reversal bar. If it pushes down to 73.29 on a smaller, faster chart, that becomes exactly where my reversal bar prints. And no, this cannot be a marker. This is nothing more than a sign. That's such a good question. That's nothing more than a sign that says this is where this bar becomes a down bar. That's a great question because look at that. It looks like an area inside of favorable large triggers, doesn't it? Jen, thank you. It's never even occurred to me. Never even occurred to me, but that makes total sense. So thank you for that. Guys, wait for the reversal bar. Identify your triggers. Identify the areas inside of the triggers. And we had this great lesson this morning. Guys, if you see an area that's beyond that correction point, it's no longer in your window of opportunities. It's no longer an area that we expect to stop the market. It's no longer an area inside of favorable large triggers or create a bounce. This is not a part of the equation, guys. So PFI, that picture you posted with the mid band on the wrong side of the triggers, it didn't do anything to stop that market. And then I think we've already, check it out, John C. If I got a reversal bar right now, come on now. Here's my triggers. The closest areas I have are way on the other side of them. Do you see it? So with what we're talking about, let's go through it. And let me show you how easy it can be. And it takes practice for it to be easy. Do I have the advantage of momentum? What do you guys think? The smalls are inside of the large. This is that weakening. Anything can happen. Look, exactly, Paul. So Pete, in order to have momentum, there has to be some sort of separation. Smalls outside. It's not even slowing down, John. It's gone. Momentum is gone. When price works its way inside of the large triggers, this is that weakening of the large triggers. Your advantage of odds favorable momentum ended right here. And the second that line came in, anything can happen, my friend. We are weak. There is no momentum. Does that make sense, everybody? Awesome. So I don't have odds favorable momentum. Let's look at the most current bar, the very top of it. Do I have a clear path? Price didn't reach an area, right? All my triggers cleared the previous. So my large chart read, ladies and gentlemen, is, it's already lost it, Pete, is I have weak triggers, rule 1 not met, but I do have a clear path, rule 2 met. Does that make sense, everybody? So let me do this. This is my favorite tool. I think everybody should build one of these. Check it out. I don't have momentum, but I do have a clear path. Does that make sense? That's our large chart read, ladies and gentlemen. So rule number 3 says that I must have, let's use a call out, not a box. Rule number 3 says that I must have areas, right? Fib, mid-band, yellow 1-to-1s, and they need to be inside of favorable large triggers. Guys, I have favorable large triggers. Do you agree? My large and synthetic are one on top of the other, 100%. That's a sexy trigger look, guys. That's as favorable as they could ever possibly be. But where are my areas? They're on the wrong side, right? They're not inside of favorable large triggers. My areas are, and I want you to use this language, beyond the correction point. They're beyond the correction point, which means that if price retraces, and this is such a good lesson, I think. Is this mid-band going to stop it? Are these yellow 1-to-1s going to stop it? Is this fib going to stop it? Is it going to be these 1-to-1s? Is it going to be this fib? Is it going to be the mid-band? Are those weak triggers going to cause a retracement all the way down here? Maybe all the way down here? Guys, what you have to learn to say, exactly Paul Flowers, is nobody knows. These areas are floating in space, guys. Nobody knows. So let's go back to this one. If I don't have areas inside of triggers, if I don't have momentum, this is the question that you have to learn to ask yourself. If 2/3 of my advantages are gone, do I really want to put my faith in nothing but one? And guys, this is what happens when you start to speak in terms of advantages. If you look at your chart and you say to yourself, I don't have momentum, I don't have areas inside of favorable large triggers, should I hope that this clear path carries me to the promised land? For the brand new user, the answer should be no. The answer should be, you know what? I'm not going to hope that one of these lines holds because I just don't have the ability to be precise. I don't have the ability to manage my risk. I don't have the ability to pinpoint exactly where it's going to hold. So I choose not to take a trade. So once you can identify the window inside of favorable large triggers, once you can go through it and say, I wait for the reversal bar, then identify the triggers, my correction point. And once I identify the correction point, I have to find a line inside of the correction point. Does everyone see how there's only one line inside of the triggers? And do you notice that I never say inside of the synthetic triggers? I never say inside of the large triggers. I say the area inside of the triggers. That's favorable because the correction point's unique. These areas beyond are not in my window of opportunity. They're not at all where I expect the market to continue. I'm going to activate a limit order just below the lowest point of resistance inside of favorable large triggers. This is where my entry comes for the high probability trend trade. I'm going to activate my limit order just above the highest point of support inside of favorable large triggers. This is where my entry comes from, guys, and we do that because the large chart has odds favorable momentum and absolutely nothing in the way. I don't want to miss this trade, so I'm going to get in at the top. I'm waiting, Malcolm. What was your question? You told me you had something to ask, but you haven't asked it yet, so talk to me about it. I gotcha. Guys, I think this is probably one of my favorite classes in a long time because you guys are being crazy vocal, and that's exactly what we want. And if this one has to run over today, guys, we're going to hang out and let it run over because I'm loving this. I hope you guys are getting something out of it today. On this picture, you just said favorable large triggers, and then you said I didn't say. So Malcolm, the rules say, no, cool. I know exactly what you're saying. The rules say areas have to be inside of triggers. It doesn't say synthetic. It doesn't say large. It just says triggers. Are you cool with that? But Malcolm, the one thing that I teach in this classroom, because this classroom is dedicated to you newer users typically, is that your highest possible advantage comes from what we call favorable large triggers. And that's when they're overlapping one on top of the other. But maybe this picture has it. Let me see. Sometimes your mid-band might be inside of the large triggers, but your support is inside of synthetic triggers. Can you see that in the picture? So I'm not crazy worried about if this line is only inside of the large but not the synthetic, and if this is only inside of the synthetic. What I'm talking about is this line down here, Malcolm. This line that is not inside of triggers isn't in the window, and that impacting the triggers, Malcolm, is not the entry. But impacting the line inside of the triggers is. Does that make sense? It's not where price hits the triggers. It's where price hits the line inside of the triggers. Awesome. Great question. Thank you. Guys, I'm going to tell you right now, I'm going to say stuff that doesn't resonate. You got to do exactly what Malcolm did. No, that's great. Ask for clarity every time, Malcolm. And guys, here's the amazing thing. Is once you know where the market is likely to continue, once you understand the rules for entry on the high probability trend trade, well, then you understand where the market shouldn't go. And it shouldn't go beyond that correction point. It shouldn't go beyond those areas inside of the correction point. So your window of opportunity is your first step in managing trades, guys, because the very basic management plan that I'm about to hand you guys says that your initial stop goes where the market shouldn't go. It goes beyond those trigger lines, beyond that correction point. John, I traded 2 lot. I like new users trading 2 contracts on their simulator because it does 2 things. And when I show management, you'll see exactly why. And I'll address that very specific point. No, absolutely not. So check it out, John. Great question. And in both of these pictures, right, the large chart has odds favorable momentum to the upside. The large chart has absolutely nothing in the way to the upside. The large chart has odds favorable momentum to the downside. The large chart has absolutely nothing in the way to the downside. So this box represents the window where the market is most likely to continue, right? My limit order is going to be at the bottom because of these 2 advantages. My limit order is going to be right here at the top because of these 2 advantages. Does that make sense? Because the large crowd, guys, the people in charge are screaming to the upside, and we're relying on these yahoos that fight everything to get us to our entry point. So I'm always, John, always, I'm in just below the lowest point of resistance, or I'm in just above the highest point. Your question was based on the downside one. On this one, this one or this one? So you're asking, does it go at the mid band or does it go at the 1-to-1s? Am I reading that right? Cool. So let's do this, John. And I'm going to go back to language a little bit on this one. If the rules say areas inside of favorable large triggers, right? It doesn't, it tells you what the areas may need to be. Fibs, midbands, yellow 1-to-1s. So the areas that we're looking for. The areas, I love these questions. The areas inside of favorable large triggers are, in this case, Fibonacci support, yellow 1-to-1s, and a midbands. Guys, these are your 3 options. These are the 3 options to be inside of the triggers. So I have a midband, right? And I have yellow 1-to-1s. So John, if my yellow 1-to-1s were here and my midband was here, would that change the entry? Would that change where I put my limit order? I think I understand your question. The answer is no. If this were a fib, it wouldn't change it. If it were the 3, one on top of the other, that would be magical. So it's always in a long trade at the highest point of support, no matter what it is. And then rather than putting one here and one here, if you tried to put a limit order on both sides, right? Well, then your second contract never got filled. Does that make sense? So let's go to stop placement. When you understand where the market is most likely to continue, when you understand that entry point, when you can look at it and you can say, I I know where the market is most likely to continue. I know where that bounce should happen. I understand completely where it should be, right? It should be from the highest point of support to the lowest point of support. And let's make this really easy to see. And that's my window of opportunity. I am, David. So I'm always going to enter at the top of this one, John. 100%. I'm in at the top because of the advantages on the large chart, because of that momentum and that clear path. I love this question. But because I know that it's an area, because I know it's a window, John, I'm 2 contracts strong right at the top, right? But I know without question that it could go further into the window, but I can stagger them if I want to. But I really want to just make sure that I get filled because I have every advantage that I could ever hope for. And if it goes down to the fibs, that's cool. I'm still in. And I'm all right with it because I'm still in the window of opportunity. And if it goes to the next fib, I don't have any fear whatsoever because I still have odds favorable and I still have that clear path. Unless it's a short trade, John, then it's the lowest. And even if it pulls all the way down here to these yellow 1-to-1s, man, John, at this point, I'm down 10 ticks. But I've done so much study, and I've practiced, and I've studied, and I've gone back and I've circled tails. But I'm in the window, and I don't worry about it. I don't worry about red numbers, John. I worry about advantages. I don't worry about little insignificant drawdowns on a small chart. I worry about the overall look. And the overall look says that I have odds favorable, clear path, and I just got in where the market is most likely to continue. And here's the deal. So when do I get nervous? About 4 or 5 ticks beyond that window of opportunity. When you can pinpoint where the market is most likely to continue, you know where it shouldn't go. And that's where your first stop will go, John. So if I'm in at the lowest point of resistance, I fully expect it to go to the highest, but I'm not willing to risk it because I want to make sure that I'm in that trade. And if I'm in at the highest point of support, I'm cool if it drops down to that lower support. Doesn't matter to me. I'm still in the window. But if it blows beyond that correction point, if it blows beyond that window of opportunity, I've got like a catcher's mitt. I've got my protective stop. And John, this is where the high probability trend trade becomes a loser beyond that window of opportunity. This is where I have a protective stop saying that my advantage is no longer in place. It's no longer my trade. And guys, I'm going to tell you right now, anything that wins 70 to 80% of the time is mathematically obligated to lose 20 to 30% of the time. If you take this highest probability trend trade 100 times, guys, you're probably going to lose 20 to 30 of them. You don't get to pick which 20 to 30, which is why it's so important that you don't focus on that one trade result, guys. You focus on whether or not you have advantages. You focus about whether or not you took the trade. 10 ticks, where did you get that? Did you just make that number up? 4 or 5 ticks above the trigger lines. And here's the cool thing, Paul, is sometimes it might just be 5 or 6 ticks from your entry. Sometimes it might be 17 ticks from your entry. It just depends on how big the window of opportunity is. So kind of compounding on that split triggers thing, if your management rules say that your stop goes beyond the window of opportunity, right, beyond those trigger lines, and that's the language that you're using, when I've got these ugly split triggers, if I jump in down here, my stop still goes way up here. That's a lot of risk. But if I have those very consolidated, one on top of the other lines, my risk is virtually, I mean, it's minimal. So 4 to 5 ticks beyond that correction point. And here's the cool thing, Paul, is if you're very, very mechanical with your management, I'm going to give you this plan, and you enter right here at the mid-band, right? Once I get a reversal bar in the direction of my trend, I can reduce my risk a couple ticks below it, and it's not uncommon to see Nexgen users only giving up 30, 40 bucks a contract on the trades that don't work, instead of putting their stops way down here where the market is just so far beyond any advantage. And I'll see this a lot in the beginning. You guys will put it way down here, 12 ticks. And you'll take that $120 hickey. And then as you begin to go through and you begin to study, you're going to realize that losers don't have to be that big. That your precision is so outrageous that you're going to be able to minimize risk dramatically with these great entries. So, guys, I'm telling you right now, best questions ever. You guys are absolutely killing it. And you guys remember that weak triggers? Remember that no areas inside of trigger lines? Did anybody avoid a loser by just following some very simple rules? Did anybody avoid a loser by saying 2/3 of my rules not met? It's not worth it for me to take this trade. And guys, that's a real world example right now. And I'm telling you, if you keep it simple, if you focus on advantages for 30 days, if you focus on entries for the highest probability trend trade for 30 days, you're going to be this amazing chart reader. You're going to be speaking to yourself in terms of advantages. But guys, one of the things that I want you to do is I want you to make these looks easy. So I created this document. This is the Chart Reading 101. And guys, this is where I tell you, guess what? You're going to have to work just a little bit. So in order to get to where you want to be, where are my new users? To get to where you want to be, Doug. To get to where you want to be, Jeffrey, Gerard, like all you guys. What you need to do is you've got to be able to recognize some looks and patterns quickly. David, did you enter it anyway? Oh, no, you took a pullback 2 ticks below the line with all the momentum and decided to get paid with all that momentum? Morgan, that's okay. That was a tough one. That one stopped just a little short. David, beautiful. So guys, what you're going to do is you're going to begin to recognize momentum, right? And once you're comfortable recognizing momentum, you're going to have to make sure that the path is clear. Guys, these are just the rules, right? Once you can identify momentum, you got to make sure there's a clear path. And once there's a clear path, you have to get an entry area. So this document, this drill, guys, is designed to get you where you want to be. 99% of you in this room are going to fight it because it feels like work, right? 99% of you are like, oh, it's cool, I remember. 99% of you are going to be like, man, I don't want to have to take all these pictures. I just want to get paid. Well, 99% of you are going to spin your wheels longer than you need to, guys. If you take 25 pictures of each, strong triggers, weak triggers, clear path, termination, what happens is you identify these things in a fraction of a second. You're going to take those pictures and you're going to drop them into the 101 section, guys. Strong triggers, weak triggers, right? Because if I know what strength looks like, I have to know what weakness looks like. And one of you told me earlier that this was strong triggers. And that's okay, but it means that you have to go back and study this look. It wasn't strong triggers. The advantage was gone. And look at the result. So the idea is that you make it easy. And don't just take a picture, guys. Talk about the whys. Why is it strong triggers? Well, it's the separation between the small and the large. Why is it weak triggers? Because the smalls have worked their way inside of the large. What's my advantage with strength, right? What rule does it pertain to? Go through this drill, guys. It's 245 pictures total. It's anywhere between 4 and 8 hours, depending on how quick you are. 4 and 8 hours for chart reading mastery. 4 to 8 hours, guys, because there's no freaking way you can look at 31 pictures of strong triggers and ever confuse them for weak triggers. There's no way you can look at 25 pictures of termination conditions, of watching the market smack head first into an area and the triggers not break it, and not begin to believe that your advantage goes away. So guys, this is the first thing I'm giving you. This is your chart reading 101. And I'm also going to give you a high probability trend trade checklist with pictures of what it looks like to have the rules met. There's your strong triggers. There's your weak triggers. Never the two shall meet, right? There's your termination. There's your potential to break, and there's your broken. It's clear. It's concise. It's very black and white. There's your window of opportunity, looking for the triggers, looking for the areas, exactly where your limit order goes for both longs and shorts. Guys, use this to check yourself as you're taking pictures. Take this high probability trend trade checklist, print it out, put it on your desk. Write these rules on the chart. Learn to police yourself. I've never had anybody in the history of this checklist follow it and do worse than 70%. Is there anyone in this room that isn't here because they want to make money? Is there anyone in this room that doesn't want an advantage every time they take a trade? There shouldn't be. You're in the wrong room if you're just here for the fun of it. I appreciate you being here. Tell jokes. But the cool thing is, guys, is this very simple approach to trading gives you the opportunity to make money while you continue to become a chart reader. And that's what this is for. This is your KISS plan. Your KISS plan says that this is the best of the best, guys. This is a stepping stone in your learning journey. This is the first trade that you need to master. And once you master this trade, guys, you're a chart reader. And once you're a chart reader, it's freaking amazing how many opportunities present themselves in the market. But this is only the stepping stone, guys. This is making you set up to where you need to be. It optimizes your chances of success with the high probability trend trade. It gives you the best case scenario. But it's going to be through simulation, study, class feedback, and continuous practice. You'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. Guys, when you can read your charts, you're going to find more entries. You're going to be able to manage more aggressively. You're going to be able to get in where you couldn't before, and you're going to see patterns that you never saw. So this gets you to that point, and your simple plan for consistency is don't fight the large chart. Don't fight the large chart triggers. Don't fight the large chart areas. If you can do that, if you can work this in and make this an absolute in your world, you are omitting 60 to 70% of the most common mistakes new users make. And then you have to define your entry, guys. Not my entry. Don't worry about my entries. I'm not paying your bills. You have to define your entry, guys. You have to be able to look at your chart and say, this is what it takes to get me into a trade. I need strong triggers. I need a clear path. I absolutely, positively, without question, have to wait for a reversal bar. And once I get that reversal bar, I'm going to find the correction point. I'm going to look for those large triggers. But I'm not going to stop there. I'm going to refine that big box into a small box. And I'm going to look for the areas inside of those favorable large triggers. And once I've identified them, I'm going to activate a limit right at the bottom, and I'm going to say, come get me. I am done. There's nothing else I can do, guys. Just pray, rub the rosaries, whatever you have to do. But you're going to know with a little bit of study, with some practice, that if they come back and hit your limit order, that you're in a short trade with momentum, a clear path, where the market is most likely to continue, and you know that it's an entry that typically wins 70 to 80% of the time. You have to define your entry. You have to hold yourself accountable to it. And then once you're in the trade, you're going to have to manage it. And guys, management's the scary part, right? Management means you have something to lose. Guys, great trades or great entries create manageable trades. Great entries create low risk. Great entries create high profits. Great entries remove fear. Great entries already give you all of these advantages. And then once you're in, guys, this very simple management plan right there for you on the KISS plan, right for you there in the spreadsheet. Oh man, have fun at the beach. Left me one at 10. Cool, we'll talk about it. Your management plan is dependent 100% on your entries, guys. So don't forego the idea of finding the best of the best entries, because that's how your plan starts. Your initial stop goes where the market shouldn't go, 4 or 5 ticks beyond the window. And if it gives you a reversal bar, instead of stopping you out, your next stop is 2 ticks above the reversal bar. And then once you're in this one, guys, and who was asking about 2 contracts? Let me tell you why I do 2 contracts, guys. I'm entering with 2 contracts. Steve T, would you mind showing me a picture? A lot of you guys don't know this, but I'm a tattoo artist when I'm not teaching you guys how to trade. I'm very artsy-fartsy, and if you ask me to use my imagination, there's going to be a dragon swirling around that resistance. So help me out with a picture. It keeps my brain focused. Guys, once I'm in this trade, 2 contracts, The market has given me the reversal bar. It says, hey, Mark, we're going in the direction of the trade. Reduce your risk and sit on your hands. You're either going to get stopped out or you're going to hit your first target. Guys, your management plan has to be very if-then in the beginning. Your management plan is very pragmatic. It has nothing to do with your fears or hopes. And if you don't get stopped out, and with all those advantages, it's very likely to hit your first target. Your first contract comes off at $100. This creates confidence. This creates trust. This creates, well, revenue, right? That's $100 that nobody can take from you, guys. And this $100 isn't a lot of money in most of our lives, right? If we lost $100, we'd be okay with it. But the idea in trading is that trading is never about the day. Trading is about the overall. And if all you did was $100 a day, guys, doesn't $24,000 sound pretty cool? $24,000 at the end of the year from a stupid $100 a day? Pretty awesome, right? But here's the deal, is you're not done. You still have an active contract. Sounds good, David. Have a good one, man. And you have absolutely no risk now. You have no risk in that trade, which makes it easier to have the courage to hold for the second contract. And if it hits the second contract, well, then you just made $300. It's only $200 in the distance. And guys, this is the beginning. Get in, move your stops, not because of fear, but because that's what the rules say. Take your exits, not because of fear, but because that's what the rules say. And once you do this for a month, right, while you're learning these high probability trend trades, while you're practicing these high probability trend trades, guys, you're eventually going to create a plan based on your ability to read the indicators. We're going to work together. We're going to recognize patterns. We're going to come up with different exit criteria. You're going to come up with different entry criteria. But if you keep it super simple in the beginning, guys, keep it very, very focused in the beginning. Talk about advantages in the beginning from the spreadsheet. You'll be able to catch short trades at the best spot possible. You'll be able to catch long trades at the best spot possible. You can study 350 pictures of Nexgen users absolutely crushing it. You can look at management. There's your mechanical plan. There's the reasons to hold for bigger moves, patterns, terminations. Guys, if you keep it simple in the very beginning, if you allow yourself to not get sucked into keeping up with the Joneses and doing what everybody does, life's pretty easy. So when I told you in the beginning, I'm going to give you everything that you need to be successful, I've done it. I've given you the highest probability trend trade that you can take, and I've taught you what each look looks like, and I've given you a plan to go back and study that look. I have given you a solid plan to optimize your chances. I've told you where to find it, why we use the two charts, how to pinpoint, how to get in at the right spot. We've taught you that you can circle tails and find entries. You have everything that you need at this point to be successful except repetition. So that's up to you. All right, Steve T, we're going to do two things here, okay? You're going to love this. This is like watching me 3 years ago. If I had a nickel for every time I showed this picture to my brother, and we're just going to backtrack a little bit. So the large chart is going to define what? It's going to define direction through the background color, everybody. It's going to define momentum using strong trigger lines, and it's going to define areas. So if price reaches an area, isn't that the recipe? Do you guys remember that? For a termination condition, the first thing that has to happen is price has to reach it, right? Price has to reach an area. So price hasn't reached this fib down here, has it? Could this ever be a termination condition? Could this fib, right now in the moment, could I ever call it a termination condition? What if we changed our language? If price hasn't reached it and I'm looking for a short, let's call it a target. Let's call it a cool understanding of where the market is likely to go. So Steve, on your large chart, we have direction, it's down. We have momentum through rule number 1. And what we have is the potential to break this area because of the momentum. Does that make sense? So we've defined all of this on the large chart. So on the small chart, This is nothing more than an entry chart. What's my only job on the small chart? To take a pullback to an area inside of triggers. So here was my first pullback to an area inside of triggers. And these one-to-ones haven't even reached them yet. Not in this picture, but I see that you're hiding it. They did reach it, and they had a divergence. Man, I got a lot of stuff open. So let's see what happened. Almost made it. That was a tough one. Never made it, right? Not worried about it. And then down here, it finally reached the area. And look what happened when rule number 2 wasn't met. So Steve, this is a cool little phenomenon. And I did this a lot. In the beginning, I would say, yeah, my large chart rules were met, John. And guys, remember, I'm talking to the guy that wrote the software, the guy that's got just buckets of confidence reading indicators. And I'm like, but the problem is John, I hit one-to-ones and that's a termination. He's like, Mark, large chart, large chart, large chart, large chart. Remember the large chart. And I don't know how many times he said that to me. Large chart leads the way. And it probably took me a year to believe him. True story. Probably took me a year to believe him about the large chart. So Steve, this is totally normal. Remember that your small chart is an entry chart, that your small chart is where we're going to find those pullbacks. And here's kind of a cool thing. Because they're two different charts, I made this picture one day because people are like, I keep hitting termination conditions on the small chart. My large chart is a 50-50 because it's a 13-2 chart. It's different trigger lines, different moving averages. On my small chart, it looks just like a termination condition, doesn't it? This fib is this fib. On my large chart, it has the potential to break. On the small chart, it's pretty freaking ugly. And I would talk myself out of this entry all the time, Steve. Well, I can't take this one because it hit a termination condition, right? When my real line of thinking should have been, this area has the potential to break because of all this momentum. Let me see if I can find a low risk entry right at areas inside of favorable large triggers. And sure enough, it creates a huge opportunity. But this line is exactly what I needed to give me a bounce back to the perfect entry. And they scared the ever-loving crap out of me forever, Steve. This divergence would keep me out of a trade, and I had to keep my rules very basic and focused. It takes 3 divergences on the small chart to kill a high probability trend trade. And I would let all these different things keep me out. Well, the small triggers turned against me. But the large chart defines momentum. And these are all things that I had to work through. And I'm glad that I did because I think it streamlines the process for you guys a little bit. When I make mistakes, and guys, I've made a million mistakes, but my mistakes, whether it's management, whether it's entries, whether it's fear, whether it's greed, I bring them all to this classroom and I share them with you guys. So I try to cut down your learning curve. I try to make it so that you don't have the same challenges I do. So good stuff. Hey, Chris, welcome to the room, man. Nice to have you. Chris, I'm going to give you the best I can give you right off the bat. You ready? Your first 3 days with me. That's you right there. And this is for everybody. Your first 3 days. You're drinking from a fire hose, brother. You are like, holy crap, what am I listening to? But the cool thing is, and I promise you this, the way I teach this classroom is it revolves around simplicity, and it revolves around a very basic understanding of only 3 concepts. And I teach them every morning. Repetition is key. And if you allow yourself, Chris, to focus on understanding momentum and then coupling it with a clear path, and then working on your entry areas, by the end of your first week, 5 days with me, if you allow it to be simple, you're probably going to be picking off these unbelievable entries for high probability trend trades and putting yourself in a great position. The more you fight simplicity, all the time, Morgan, the more you fight simplicity, the longer it's going to take you. But I'm telling you right now, there's nobody that can't do this. There is absolutely nobody that can't do this. And when you take those few simple concepts, rules kept you out of the losing short or the losing long. Rules kept you out of the losing short. Rules kept you out of that one right there. And it's pretty cool. And what you have to realize is that not every move is your move. Everything that I teach is based off of statistical advantage. Everything that I teach is based off of patterns that have been repeating themselves since probably the market ever started. And we're just learning how to capitalize on a couple simple advantages. And we're letting the people that move the market move the market. We're not trying to move it for them. We're just we're remoras to sharks. These guys create advantages. We're going to take advantage of all their hard work, guys. We're going to jump in and we're going to take our little piece of the pie, and then we're going to GTFO and go on to the next trade. So with that said, my throat is dry, guys. That was a 2-hour first hour, which I absolutely love. There you go. John C., termination pushed the market all the way up to resistance. When it hit resistance, your large triggers were a full bar away. This is the gap theory. And what this tells me is that when price accelerates away from those large triggers and hits an area and the large triggers are a full bar away, guess what? Price is likely to close the gap back to those triggers. What does that tell me? This tells me, dude, don't take that long with those ugly triggers, right? It's likely. So, John, absolutely. And how do I know? And John, I was an English lit major. I believe language is crazy important. Rule 2. If price reaches an area, that's the first part. Do you see how it reached the area? It made it to Fibonacci resistance. And the triggers, or the riggers, the triggers remain below the area. This is a termination. Rule 2 not met. No clear path. No longs. So John, what I just did is I said, here's my first condition. Here's my second condition. This is what it means to me. That's a textbook termination condition. I'm going to take this picture and I'm going to go over here to termination conditions and I'm going to drop it in. And now I've got it. And John, you want to see something cool? You're going to dig this. I'm going to take this picture and I'm going to get rid of this and I'm going to get rid of these. And I'm going to take this and watch this. I'm going to change below to above. And I'm going to change longs to shorts. And in one picture, my friend, I've identified termination conditions at a low, and I've identified termination conditions at a high. And the only thing from the recipe that changed, the only thing that changed was triggers below changed into triggers above. That no more longs went into no shorts. And John, this is 2 times where you didn't have to give away money for breaking rules. Does that make sense? So I'm going to take the same darn picture and I'm going to go to the 101 and I'm going to do it again, guys. So I'm going to ask you, everybody in the room, I'm going to click on terminations from my spreadsheet real quick. Here's the first one. Price reached Fibonacci support. All the triggers were above. No short trades. No is a term. No clear path. Thank my lucky stars. Look at the bounce. Let's go to the second picture. There's all sorts of termination conditions, right? So I'm studying this one. The language is on there. There it is at a support. There it is at resistance. There it is at a divergence high. Is there anyone in this room that thinks that if they looked at 25, 30, 40 pictures of termination conditions, that they wouldn't believe it? That they wouldn't believe that that removes their advantage? That they wouldn't believe that if price reaches Fibonacci support and all the triggers are above it, that short trades may not be their best course of action? Or that if I have weak triggers, the advantage of momentum doesn't seem to be there. And when I have strong triggers, hell, it even breaks areas. And when I reach resistance and the triggers are below, how many of these pictures do you need to see to not break the rules? And that's kind of what we're doing, guys, is we're going through and we're just through repetition. If you see something enough, you learn to believe it. And like Morgan said, if you watch the same movie 10 times, you're going to catch something different every movie or every viewing. You're going to find a joke that you missed, or you're going to see a scene that you didn't recognize, or something in the background that wasn't clear. And learning to day trade is very similar to that, guys. When you were 15 and learning to drive, you don't remember anything from point A to B. You're so hyper-focused on getting to that next area that the radio's off, and you don't know if it's raining or sunny, and you don't know what color the car next to you is. But when you've been driving for a while, everything kind of clears out, and you're more relaxed, and you see more, and you become safer. So, good stuff. All right, guys, I have to take a break. When I come back, we're going to start clicking on charts. We're going to refer all charts to advantages, and we're going to see what's going on. John, you do me a favor. Okay? I just gave you about 8 fish. You take a picture, and I want you to write the rules for termination conditions on it. And I want you to tell me if it's a termination condition. Guys, everybody do it at 8:40 a.m. Because what good does it do if I do it for you? So everybody, I want you to take a picture of this. And John, I just want you to take the picture. And this is everybody, right? Good one for the spreadsheet. And for this point right here, I want you to write out the rules for a termination condition. And if you're not sure what they are, there's a cheat sheet. I'll be back in 5 minutes, guys. Let me know how that one works out. Post your answers in the room. I'll see you in 5. patterns. So I'm back. Let's get going. There's a termination. Chris H., you said that it was a termination at divergence. I love it. And Chris, what you did is you just opened up an amazing lesson for divergence. John C., what did you get? Was it a termination condition? Absolutely it is, right? Do you guys need help taking pictures? We can do that. Why was it a termination condition? So if we write it out, you got it, Daryl. So let's do this. Let's take the picture again and let's go through it. Guys, everybody should have Capture software. It's part of the downloading process when you get software. If you don't, let me go to the server, to the user guide real quick, the software guide. If you don't have, if you can't find it, here's the link. Go download it. It takes 2 seconds. And guys, this is also the page that gives you all the how-to on pictures. So there's really no excuse to not be able to post pictures, because if you can't do it, all you have to do is ask for help. So let's do this. Let's open up our Capture software. It's just a big red button that says Capture. And let's do 2 charts just for grins. Here, and we'll line them both up at 840. So Capture software, when I click the big red button, if I hover over one chart, it gives me one chart's worth of information. Guys, we got to get both charts. I need a large chart and a small chart. So what I'm going to do is I'm going to left click in the upper left hand corner and I'm going to drag all the way down to the bottom right. And it's real important that you guys post in timestamps and prices, because we're going to line some stuff up. Once you release the mouse, it's going to let you take a picture. When you take a picture, you're going to be able to vandalize it, guys. And this is how we have a conversation. We're going to have a conversation via pictures. So it's easy to ask a question in the room. It's so much easier to post a picture, say, hey, Mark, this is the one in question. Each of these tools is click and drag as well. So if I left click and drag my mouse anywhere, that arrow goes all over the place. In this case, I want it to point right to the termination. I could put a shape up there, again, click and drag. And then guys, the call out button. This is how we're gonna talk. And you're gonna say price reached the fib, triggers remained below. Hey Mark, is this a term? And I'm gonna be like, yeah it is. And you might say it's a termination at divergence, right Chris H? So there's a cool thing about divergence, and here's a little side lesson, is when price comes down and goes back up, right about the 3rd bar, your software runs a calculation, and if there's a loss of momentum, we get this divergence line. Does that make sense? Price goes down right about the 3rd bar up. If there's a loss of momentum, you'll see this line print. So right here, about the 3rd bar down, is where this pink line actually forms. So it's not a termination at divergence. It's just a termination. The divergence comes later. And Chris, we're going to use these lines the same way we use fibs. Here we had the loss of momentum. It gave us the line. When price reaches that line and the triggers remain above, we can call that a termination condition. But on its own, it's nothing more than a loss of momentum, and I don't even know that it's happened until all the way down here. Does that make sense? We use these lines on the large chart later on to define termination conditions. Good stuff. Guys, once you have this, just click copy. Come over to the room, Control V, and drop it into the room. Control V if you're in the pop-out. Or you can click upload, and it'll give you a link to it, Click copy there. Drop that in the room. This is how we're going to have conversations, guys. And the people that post the most, those are the people that are going to get to where they want to be the fastest. And then just close it out. And where are we right now? Odds favorable momentum. Everything says up. I'm coming from a termination. You have ES open. That's okay. The patterns are the same on every chart, Chris. If I get a reversal bar, the top of my triggers to the bottom of my triggers, the highest point of support to the lowest point of support, if I get a reversal bar, guys, my plan, my rules say that that's my entry right there. A tick or two above the highest point of support inside of favorable large triggers. I don't even have a reversal bar and I know exactly where that market is most likely to continue. Guys, what happens if those triggers continue up and these one-to-ones fall outside of them? Rule number 3 is no longer met. But that's how quickly your analysis is going to come into play, guys. All right, I'm going to start clicking on charts. Let's see what you guys have been doing. What an awesome class. You guys have kept me busy. Scrolling up, scrolling up, scrolling up. All right, Paul. Price is coming down. Triggers don't agree until here. And then we get a 50-50 on a divergence low. That one doesn't work. And then we get a 50-50 on a high. And you have 1, 2, 3 areas that aren't broken. You've got a beautiful entry area, but you've already had divergence from the high with the potential to break but not broken. You take the entry, you get paid quickly and out break even. That's insanely good management on a low probability trade or a medium probability trade. Josh says when everything is screaming down, I'll take the pullback to resistance and I'll get paid. Guys, this is textbook. Go in there, read his annotations. That's everything that we look for, guys. It's the exact same pattern. Jen says, no clear path, so let me wait for it to clear. Not the gap, though. Not a gap. Okay. And then once she gets momentum with the potential to clear, she takes a long, gets out at trouble. Once she gets the next opportunity, she takes another entry, gets out at trouble. Jen, 2 trades in 1 move, and now it's time to go have a pint. Beautiful trading. And then, guys, don't forget that the waiting is the hardest part. And then Paul, 50-50. Man, not even 50-50 where you're in, Paul. Awesome. Not yet, Iron Mike. I'm going through them right now. And then Jonathan, a reversal bar just means that after all these green bars, you get a red bar. After all these red bars, you get a green bar. It's a reversal. It's just going the other direction. That's it. That's all it means. Don't give it any more power than that. I love this. Right into a termination. What the heck is wrong with me? I'm not even basic anymore. Paul, dude, you got to make mistakes. If you don't, you're never going to grow. It's like if anyone's ever lifted weights, guys, muscles don't grow unless you stress them out and there's failure. Humans are the same. If you don't make mistakes every now and then, you're not going to learn how to avoid them. And Paul said he traded right into a termination condition, and it didn't work out. It cost him money. And that's pretty common, guys. Trading into termination conditions is rarely a long-term plan for success. So you've got to trade into them 4 or 5 times. So you finally go, man, I'm tired of losing money. Let me stop trading into termination conditions. And then I like this one. So PFI, are you still in here? Here's your initial question. Did you get your answer? If there's not an area inside of favorable large triggers, what do you think? And it's never my experience, guys. It's always my rules. Rules, my experience means nothing. My experience doesn't outweigh rules. So if my rules are met, then I'm good. And if not, no worries. All right, Pete, let's see what we have. It happens sometimes, Paul. And yeah, and then Jonathan, that's where this bar will become a reversal bar. That's where this bar will become a reversal bar. Exactly. All right, Pete. Small triggers crossed above large triggers, mid-band. Turned at fib at resistance with weak triggers. Couldn't break the area. There's your reversal. And off it goes. So what do we have? We have area that didn't break, reversed the market, took it right up to the next key area. It bounces, retests it, weak triggers say probably not going, comes all the way down where the sellers try to break all these areas of support, but they can't. Buyers take back over, pushes with odds favorable momentum, all the way up to the key area. I love it. This is just great chart reading, guys. That's all it is. It's just awesome chart reading. And then the next step is finding a way to take advantage of it, right? Maybe with all this momentum and things going up, you find a way to capitalize. So first I learned the language, I learned the rules, and then I learned how to use those rules to my advantage. All right, let's see who's next. Jen, we clicked on that one already. Paul, termination. No entry on this 50-50. Not even a 50-50, Paul. Do you see it? That's a termination, 100%. Is that divergence at the top of the, or a fib, the 76%? Right here, that 76% is the byproduct of the calculation that creates the divergence line. Means nothing. If this magenta line prints, there was a loss of momentum. So what you're looking at, Pete, is you cleared the areas, right? Your triggers got above. And you're starting to think, man, heck yeah, we're going up. And then you recognize that you don't have momentum at all. Rule number 1 definitely wasn't met. And without that momentum, boom, to the basement, brother. Great read. I love it. But it didn't turn at fib resistance. It exceeded. It just turned because of those anything can happen triggers. Somebody with more money than me wanted it to go down. Good stuff, Pete. And then, Paul, don't call it a 50-50 if it's a termination, right? So let's go back to the recipe. If price reaches resistance and the triggers don't break, it can never be a clear path. It can't even be potential to break. So not taking this trade, Paul, was brilliant. You would have been trading directly into a termination condition. And no matter what happens after your entry, the rule was broken, the advantage was gone. It may work once, probably work just enough to convince you that breaking your rules is a good idea. Andy, divergence prints, news in a few minutes. Look at all these areas. That's a lot of risk. 50-50 from a good top. And you have 1, 2, 3, 4, 5 areas and split triggers, which means that if you get in at 77, your stop is over $200 away, right? Thanks, Paul. So here's kind of a cool thing on this one, Andy. Would it be okay And guys, this is kind of a progression. And guys, I see that there's private messages for me. I don't answer them during class. You guys get my undivided. Andy, would there be any fault in saying that with a window of opportunity this large, I like the advantages on the large chart. I'm willing to get in at the highest point so that I have the least amount of risk. And if they don't come get me, I simply won't take the trade. This is one of the things Pineski that's in this room does a lot. He says it's not perfect, so the only way that I'll enter it is with the least amount of risk possible. Which means maybe as you come through, and it didn't get that far, so not your trade, right? Maybe not your trade yet, but it might be one day. I love that you took the picture. I love that you talked yourself through it. And you were able to say to yourself, man, that's not the one for me, not yet. Let me stick to my rules because I understand fully that I will grow with this software. And then Paul, great top, hits the termination condition, divergence prints, and you're just like, man, that's not the recipe for the best of the best. I'll skip that one. And then Ron says, not quite the gap theory. Not even a little bit. Guys, sometimes you'll misunderstand the rules and get lucky, and that's exactly what Ron did. This mid-band is not a termination condition. There's nothing that says this market may push back up, especially after a pivot stop out and resistance with everything below. Sometimes you're going to get lucky, guys. I don't mind telling you that you got lucky. Don't let it hurt your feelings. Morgan, you got annotation down, brother. Let's take a look. You're absolutely right, Morgan. This top will never be a good bottom, ever. I know, it's kind of funny. It's when you get caught in the moment. But why is it a poor top? Can I annotate your annotations? This is for the new kids, not for you, Morgan. You know why it's a poor top, right? So guys, if you're learning tops and bottoms, it almost works better to say it's a bad top because triggers exceed the fib. It means that decisions weren't made at the fib, that there was a lot of indecision and fight. And guys, a bad top doesn't mean that the market won't reverse. All it means is that I'm not going to put this in my bucket of advantages. And then I do have odds favorable momentum. Everything is beautiful. And then, so what's the rule here? You put good bottom. So let's go by the same thing. Oh, I'm going to tear it apart. Don't you worry. At the time of your short, it's just a termination, right? That's all it is. Price reached an area, triggers didn't break, it's a termination condition. What does that mean? That means 32 flavors of ass whipping right over here. That means that you formed an opinion that the market should bend to your will, that you should be able to trade through termination conditions, and it didn't work out, right? So rule number 2 for the win here. And that's okay. Morgan, I'm telling you right now, if you don't trade into termination conditions as a brand new user, you're never going to learn to trust that you shouldn't trade into termination conditions. Exactly. Here we go. Let's show Morgan's morning here. There he goes. Man, I thought it was going to break this time, but it didn't. So cool, right? Let's chalk this one up for a mistake. Even with momentum, without that clear path, life isn't easy. Even with the perfect entry, that clear path seems to be a pretty big deal. And then when you get stopped out, you said, well, damn it, if it's not going to go down, then it's got to go up, right? The old, I'm mad at the market, they owe me. Has anyone else other than me ever done that? F them mofos. They're going to pay me. Yeah, we've all done it. So let's go through it. At the time of entry, do I have momentum? No, there's no momentum there. Do I have a clear path? There's no clear path. Hell, do I even have an area inside of favorable large triggers? No. So Morgan, my father-in-law had a saying. And he used to say, and he'd say it in his Arkansas hillbilly thing, son, you can shit in one hand and wish in the other. Tell me which one fills up first. And guys, that's what breaking your rules is. John's eavesdropping. There's smart car versus semi. Slamming into the back of a dump truck. I hope the driver was okay. So what happens, Morgan, and guys, this is for everybody, not just Morgan, is that if you start talking to yourself in terms of advantages, and I promise you this is going to be helpful. Morgan, if before you pull the trigger, you ask yourself, do I have momentum, a clear path, and an entry area? And if the answer is no, you simply say, you know what? I'm not going to wish in one hand and poop in the other, right? That was a revenge trade. That was totally a revenge trade. I recognize it. I perfected it. This one was taking a chance on a termination breaking because of momentum. This trade, Morgan, I could almost get on board with if I were coming from a good top and I didn't have divergence off the bottom. Does that make sense? If I had a super strong top and no divergence on the bottom, I could almost justify a little bounce. It might be worth it for me to risk 50, 60 bucks on it, but not what you did here. And Morgan, just a thought, and guys, I don't tell you what to do. I don't tell you what to do. As long as I'm still making pretty solid mistakes every now and then, as long as I find myself trading opinions a little more than rules, guys, it's okay to stay on simulator. It really is. We all have this BS idea that the only way I'm going to learn is with the skin in the game. It's just not true. It's just not true. And then Morgan, let's address this one. Waited for a pullback to the mid-band inside of the synth triggers. That's that split trigger look, right? So we know advantages are going away. There's so much information on your chart, guys, that keeps you in the safe zone. There's so much information on your chart that keeps you from making emotional decisions once you learn the rules. And Morgan, you get rock star status for putting such a well annotated chart and being willing to take the lessons in front of everybody, because there's so many great lessons on here. So many great lessons. And I think that the more we talk about them, the less likely you are to make them. All right, Steve. So what did we have? We had a pivot stop out, right? Price reached the divergence high. Awesome. Price reaches the divergence low, None of the triggers break, and off it goes the other direction. Termination creates a full reversal, guys. This is a strong bottom. And then that pivot had that divergence as well. And guys, check it out. This was at 23.13, right? Australian time. Man, it's late there, Steve. And this line doesn't come into play for about an hour and a half, right? The market goes up, hits resistance, retests it, and then Morgan, that's what you may have been going for right there, right? Was that strength into it, retest before it holds? And then when it comes back and it reaches the divergence low, none of the triggers break, right, Steve? And I don't need a divergence here because price reached the line, triggers remained above, no short trades. It's perfect. It is the perfect don't go short look. And then it does push up. Notice that your large triggers are still down, but your small triggers are trying to get up. Your large triggers are below the areas. Your small triggers haven't broken the areas. I don't have a clear path. I don't have momentum. I don't even have an area inside of what we'd consider favorable large triggers. And it doesn't surprise me that this one didn't work out in the moment. You just, remember when I said decisions are made at key areas, ladies and gentlemen? Directly into a termination condition. Pete, 100% rule 2 not met, into a termination condition. Price reached an area, none of the triggers broke. My rules say don't go short. If price exceeds a divergence low and then continues back up and trades above it, let me go to the tops and bottoms section for you guys real quick. That's what we call a pivot stop out. So if price trades below a divergence low, Pete, and then back above it, no short trades. Not only is it a termination condition, it's also a pivot stop out of a prior divergence line. And if you don't think these are powerful, check that out. It stopped the market cold. So rules, again, designed to keep you safe. And then this is just a little premature, Steve. You had the right idea. The termination, it's trying to roll. The triggers are going up. It just had to sort itself out a little bit before it was ready to head back up. And this is where the patience piece comes in. Your read was beautiful. Your anticipation was awesome. You just jumped the gun a little bit. Just a little bit. A skosh, if you will. And then, Pete, does that make sense on the short? No gap. There's no gap. Oh, on crude oil? You're welcome. Were these large triggers above the reversal bar marker? If they weren't, it wasn't the gap theory, guys. I see a termination, stop the market cold, reverses it, gives me odds favorable. And I don't know how far away those were. No, it's okay. I'm just making sure. I want to make sure that the lessons are consistent and that you guys get everything that you need. Awesome stuff, guys. So, nice one, Steve. Just a little early. Great anticipation. Just got to exercise that patience bone a little bit. Of course, if I were trading at 1:30 in the morning, I'd be so hopped up on coffee trying to stay awake. All right, Andy says that I have all sorts of gap between the two. Too many areas. I don't like the risk. I'm not taking the trade. And it's okay. It's okay to miss that one every now and then. And then Jen, there was the potential for it to clear. Smalls are through, large are not. Areas on the wrong side, right? Smashed through, didn't take the trade. That's beautiful. Had the potential, but you didn't even have the areas, wrong side, and down it goes. Jen, great picture. And then David took that beautiful short. We saw that one already. That was a hard one to catch, but David nailed it. And then Andy, that was a hard one to catch. It missed Andy by a tick. I think it missed a couple people by a tick on that one. That was a tough one. All right, Iron Mike. David, gold star on that one, man. So Iron Mike, market's going down. It has momentum. The path is clear. And you have already set up your area, right? So Iron Mike, the question is, did it hit that fib before it pulled back and hit you? No? So let me go through this real quick. Odds favorable. Clear path. The only thing that I might have changed was that this limit order, I probably would have put it below the mid band. And then when it ran you over, I would have said something clever, Mike, like, whatever. I had every advantage for a trade that typically wins 70 to 80% of the time. Which means that this is the cost of doing business. And taking this trade, can you show me the aftermath? Show it to me. Show me what it did. These are great. I agree with your entry. I think it's a little high. I want to see what it did. Guys, you're going to learn more by giving me the complete picture, showing me entries and exits, I promise. So Iron Mike, drop that one in the room. Let's see where it went to. Maybe there's something we can talk about that'll keep you from getting stopped out. And then Andy, everything down, odds favorable, potential to break, perfect entry right at the mid-band inside, money, money. Andy, nice job. Your patience paid off, right? When you don't try to build trades or create trades, they tend to come to you. Hey, what's up, huh? Yeah, William, sometimes you're the boot and sometimes you're the butt. Jonathan, perfect. Termination condition. 100%. What a great read. Guys, I love it when you post those in the room. When you say, hey, Mark, check it out. Termination condition. I didn't take a trade. Those trades lose more than they win. That's not for me. Beautiful, beautiful chart. Great annotation. And then Andy Man. Termination. Pullback area inside a favorable large triggers. I don't have any idea where you're talking. Oh, over here. Got it. That was a tough one to catch, Andy. That was such a tough one to catch because you literally had to be like 3 ticks instead of 2. That was such a hard one to catch, but it's such a good read. Everything was there, just sometimes it doesn't get you. Small's outside of the large. Everything is up. Only 1 fib inside of triggers. You nail it and you get paid all the way up to the fib. Morgan, that was you, right? So check it out. Everything says up. The path is clear. Right at support inside. Beautiful, smooth. Very easy, low stress. Hold on. Hold on. Where'd it go? Cluster Fox Trot Charlie. But Morgan, this is such an awesome lesson, right? When stuff's in the way, when triggers don't agree, when there's no areas inside, you're like, son of a bitch, I sure hope it does what I want it to. But when everything agrees, it's like smooth and effortless, isn't it? And this is that patience piece, guys. I'm telling you, if you just learn to wait, you will be absolutely floored at how effortless your trading becomes. And then Paul, I don't think it was the gap. I would have to see it in the moment to really know. All right, Iron Mike, dude, they did what they did, right? Let me see, 1041, 1041. I love the look, Iron Mike. It's so much easier. There really wasn't much to do until right about here. Maybe you had a shot, but it's not an easy shot because that one was still a little bit low. Yeah, Iron, you took the right trade, man. You followed the rules. You followed the plan. Your stop's a little big. So can we just turn this into a management coaching lesson? Actually, there's a couple things. Right on. So we're going to change that. Over time, you're going to change that, because if this is the very top of where I expect price to correct to, get back. And let me know if this makes sense. If this is where I expect price to correct to, does it make sense that 4 or 5 ticks beyond it, if it gets past that point where it's supposed to bounce per the rules, why don't I just jump out there? Why don't I take like a little $50 hickey instead of full run? And man, it's hard to do that initially, because when you're brand new, Iron Mike, you're so puckered up and adrenaline ridden that you don't even know what's going on in the beginning, which is why you have to practice that a little bit. You have to practice that management. You have to practice moving your stop where it doesn't go. One of the cool ways to do that, while we're talking about, studying and stuff, one of the cool ways to do that, one of the easy ways to do that, is go back, guys, and use that market replay. Yeah, dude, you did great. I like everything about it. You're a couple ticks below the resistance. There's a little bit of a challenge that you've got a mid-band kind of floating and resistance is on the wrong side. So rule 3 isn't perfect by any means, but with rules 1 and 2 looking so nice, I don't disagree with being a couple ticks below, but this is where I'm running tight, man. If that fib doesn't stop it, it's already beyond the correction point. I don't want to be in this trade anymore. And honestly, I might even wait for like a reversal bar or something, confirmation. I'm a firm believer in favorable large triggers and more importantly, having areas inside of them. But I could see why you took a shot, right? I might have taken a shot on this one. I probably would have waited for a reversal bar because it's not perfect. But it's a good one. But you could tighten that stop up a lot. You really could. But guys, if you go back and you use market replay to study, if you go back and you use that, that ability to replay the day, there's this cool thing that you can do. Is the market will be moving, right? And the market's moving and you're like, I think I have a short, I might have a short, I'm not sure. You can literally pause it. You can pause the market. The market looks like it's trading live, but you can pause it and you can say, wait a minute, let me double check that my rules are met, right? And then if they are, you enter that trade. And then once you're in that trade, Iron Mike, you hit pause again. And you say, let me make sure that my stop is in the right spot. And what you're doing, guys, is you're taking adherence to rules and you're seeing the potential outside of the live market, not having to make these split-second decisions, but rather being able to pause the market, right? Being able to pause it, to go back, to see what's going on. And there's a good one on market replay, how to set it up if you need help. Guys, this is one of the biggest advantages I think people can give themselves. And if you look at Paul's charts, well, his is live today. His first 5 or 6 charts in the room are all from market replay. He goes back every day and fixes mistakes. He goes back every day and replays the day and holds where he should have held and exits where he should have exited. And I'm telling you right now, the improvement that I see in the people that do this is pretty overwhelming. And then Paul ES is about to give you another one. Show me pictures. I don't have any idea. I don't have the ES up. Crude oil's got the potential to break, doesn't it? There was a quick little snapback just below resistance. That looks like the one before. Are there any areas inside of favorable large triggers? Based on rules, many, not any. Let's go through it. So let's first do the correction point. That's okay. There is, whoops, a stop sign. So which reversal bar are we talking about? On this reversal bar, there's one line inside of triggers. On this reversal bar, there's a couple floaters in the middle of nowhere, and there's a correction point up here and a correction point below it. And on this reversal bar, awesome. Take care, Mike. there is that window right there. So these are floating in the middle of nowhere, right, Jen? Which means that it could go here and it could go there, right? And with 2 correction points, it could go here and it could go here. But at least right here, I've got something for it to bounce off of. Why'd you draw arrows there if you meant this one, silly? So let's go from the bottom of the triggers to the top of the triggers. The rules never change. From the lowest point of resistance to the highest point of resistance. The rules for the window of opportunity will never change, Jen. That very basic, this is what it means. From the lowest point of resistance inside of triggers to the highest point of resistance inside of triggers. That's it. There's your window. Did it make it? A tick or two below that resistance gets you in at 73.10. And you made your $100 and now you're into your first trouble spot, but there's no reason to exit. Does that make sense? It wasn't a big pullback at all. But if you were really good at understanding your rule number 3 entry, that was it. And the second you drew this rectangle from the areas inside of favorable large triggers, you would have said, I have to sell a tick or two below that resistance. And it either would have gotten you or not, but you only had a minute maybe to make that decision, which is why you've got to go through repetition. Repetition is the key. So where are we at right now? We still have odds favorable, don't we, Jen? Morgan, have a good one, dude. Thanks for being here. We still have odds favorable momentum. It still has the potential to break. So what if I get a reversal bar right here? Can't we already do it before the reversal bar? Can't we say, here's the bottom of my triggers, here's the top of my triggers? Here's the lowest point of resistance, here's the highest point of resistance. Do you see how you can start calling your shots before you ever get all the information? And at this point, I'm just hoping for a reversal bar. And I'm hoping that it doesn't hit Fibonacci support before it gives it to me. Because if I get that bar, that's what I'm doing. That's what my rules say to do. I'm not calling trades, guys. I don't call trades in the room. That's it. That's all I can do. Sometimes it gets hit and sometimes it doesn't, right? Sometimes that first date goes amazing and you make out on the couch, and sometimes she shakes your hand and you never hear from her again. You never know. You never know. And that's why I say, Jen, don't chase. Because what's pretty common, when it doesn't hit your entry and you jump in down here, that's almost guaranteeing that reversal to get you back to the entry. So, good stuff. Guys, it's been a pretty good day today. Awful lot of lessons. I feel like you guys made me smarter for sure. I've got some work to do this afternoon. Maybe change a couple pictures. Is there anything else we need to talk about before we call it a day? PFI, did you get the answers you needed on entries? Oh, Pineski. I know that's not even what it is, but that's what I hear every time. Let's see what happened. Thanks, Tony. Guys, I'm telling you, the classes get better every time you guys come in and you post. So Chris H., man, it's going to get easier every day. You're going to have this clarity like on day 5 where you're like, whoa. And then you will. There's no hoping. Hoping's for the people that don't have Nexgen. Paul, I like this one, right? 50-50, potential to break. There is divergence. And do you see how his reversal bar split the first area inside of favorable large triggers? That one's not in the equation. Paul says, come get me up top or don't get me at all. And it gets him. And then it stops him out. His stop is perfect. He says, this is what I'm willing to risk on this trade. But the thing is, as Paul says, it's still a good trade. And when it stopped me out, I'm willing to stay in this trade. And I don't know how I feel about getting stopped out and getting in on the same bar. That's just me. I wait for the reversal bar to at least confirm it and then get back in, because this bar is just continuing up. The stop was appropriate. My second entries, I need some level of confirmation. I need something to say it's going in the direction it's supposed to go. So good stuff. Tom Petty and Mark Douglas for the win. Amen, Andy. Amen. So, guys, great class today. I can't say that enough. I had so much fun today. I hope you guys did too. Learning to day trade shouldn't be this big ordeal, guys. It should be just kind of doing what you do, taking a little bit every day and getting better at it. I'm dropping a couple little PDF books in the room for you. If you feel like reading this afternoon, these are great. If you do market replay and you want to bring your charts back in and show them to me, that would be awesome. If you take trades this afternoon and you want to share them. Dude, I love them. Andy, I'm a sucker for tiny little cars. I used to have a huge commute, and I bought a little Hyundai, little hatchback. I loved it. It was like driving a go-kart. It was so much fun. This was years ago. I put a lot of miles on that car. I'm going to take